Ilya Spivak, he's back in San Francisco. Dylan Radigan in Milan to take you through the rest of this trading hour. Futures market closes at 5 Eastern. Of course, if you're on the platform on the website, tastylive.com, thanks for joining us. Come over to YouTube. Tell us what you're trading, what you think of this action today. Stocks, of course, were hit hard in the in-between hours yesterday. We have news that NVIDIA is taking a $5.5 billion charge-off for inventory that can no longer be sold to China thanks to the Trump administration's new export bans. Export bans that were started under the Biden administration and now fully extended under Trump. We see here that AMD likewise is taking an $800 million hit. And so tech stocks, they slumped today. The Nasdaq is your loss leader, down 2.84%. Semiconductors down even more by 4.22%. The clear loser on the session, although they do settle higher than where they opened this morning at the cash equity open. We make our way through the session. We hear more about trade talk, more about potential deals that may or may not be coming together. Doesn't really matter to bonds today, which is perhaps the biggest sign of relief we've seen thus far, where notes and bonds at the long end of the curve are pushing higher in this risk-off type of session in equities. But who matters? Does it matter to gold? Gold's charging to the upside, 3.49%, a brand new all-time high here for that shiny rock, my precious gold. We will see where that's heading next.
And the dollar's useless. I mean, it's just a sad state of affairs over there.
Yeah, a currency that can't get itself off the ground. Earnings are coming up, and we have an interesting scheduled twist this week where tomorrow is the last trading day of the week, thanks to holiday on Friday. And so with Netflix earnings coming up, do you really want to trade the 2-day options? Or you can't adjust your position Friday, so you don't really have that choice this week. It's tomorrow or bust. Guys, there's a lot to cover here. Dylan, let's give Ilya a chance to breathe now that he's finally back on air. Ilya, you come back, the markets come down. Seems to be a recent timing sort of thing.
And you get a central banker saying things. It was done in your honor, Ilya.
So I left thinking this short dollar trade is getting a little long in the tooth, but I'm going to leave it on because there's no evidence not to. That was okay. That's continued to work. The bonds have come up.
Curses upon your house. Curses upon the house of the music festival goers of Portola.
Speaking of which, Cypress Hill had a wonderful celebration of their 25th anniversary at the Fillmore here in San Francisco on Friday.
Lovely to know. And I'm sure that the cinnamon rolls at the nearest bakery in Westchester are better than ever.
Why am I kitchen strays?
Just because.
on general principle. We still have the bonds situation kind of attempting to stabilize. It's a little bit better. I'm still long, but it's a little bit of ways to go. I actually got a little bit more long by selling a put vertical last week. It's kind of trying. We'll see. We'll see how this goes. But
hang on a second here. You're starting to irritate me. Hang on a second. Wait.
Just for not 9 minutes. For everyone who had the under, congrats.
I'm going to read you a quote from the chairman of the largest central bank most powerful central bank in the world.
He opined today.
And I quote, "The level of tariff increases announced so far is significantly larger than anticipated."
Yes.
And the same is likely to be true of the economic effects, which will include higher inflation and slower growth. Now, this is a comment that all of us have made. Everybody on Wall Street has made this comment.
They wrote it in their summary of economic projections a month ago.
Yeah. All of this has been said everywhere, but but when I say it, or when Jamie Dimon says it, or when Chris Vecchio says it, is very different than when the chairman of the Federal Reserve comes out in the middle of the tariff madness and reiterates it.
Yes.
And at the same time takes away any appearance because of the I word that there's going to be any sort of accelerated rate cutting in the near future.
Yes.
How is that not in defiance of the President of the United States' wishes, and how is that not negative for expectations around the behavior of rates and the bond and all the rest of it.
It has reflected a bit in Fed cut odds. So we're basically down to 100 basis points. I think at the extreme of last week's consternation, we were out to 5 cuts. We're back to 4. I think what you see in the bond market seems to be not this, because clearly in the initial sort of stages of the tariff scare, and you see it in ZB, you can see it in what Chris is showing here. You get those big spikes in the SR3Z6 contract. Same thing in the 2-year. Same thing really across everything. They spiked higher because there was the expectation that the Fed would come and bail everybody out with rate cuts. Yields were falling. This is obviously not where we find ourselves as of Monday of last week, where the bonds started to sell hard, despite none of the tariff situation being resolved, none of the growth story getting better, if anything, getting worse. And that's that big red candle right there. That is not a market that particularly cares about what the Fed is going to do with this sort of maybe they'll come to the rescue when growth sours enough kind of hope. Because frankly, I mean, we saw retail sales today, gangbusters, granted for all the wrong reasons, but nevertheless. And so they want to see this hard evidence. They didn't get it with the NFP report. That was a little better. The market seems to have looked at essentially U.S. assets and said there is sovereign uncertainty risk via term premium in the bonds, or if you want to look at that credit market indicator, Chris, that we like to look at from the Office of Financial Research, the financial stress indicator. Vol measures in all of these things are blowing out. And so what seems to be happening is an exodus from U.S. dollar-denominated assets and the dollar itself. And that's what the bonds are showing us here. There is just a level of uncertainty that's become priced in. I mean, you look at the term premium on 5-year paper, on 10-year paper, it's absolutely blowing out. And that's what you're seeing in vol readings in credit markets more generally. And the source of the financial stress is clearly uncertainty. People are just dumping dollar-denominated things. This is to Chris's
so you're saying it's not,
but
you think that all the rate you think that the predominant incentive or marginal action is not related to inflation or growth or the reserve currency status so much as it is just flight from America.
I think it's high uncertainty in America that is starting to look like currency crisis flavored, to Chris's point last week. And I don't.
But Chris's point in your absence, I'm sorry to keep interrupting, but Chris's point in your absence was there is no alternative reserve currency.
Like, he's absolutely right. He's absolutely right.
So even you can't to suggest that there's even currency crisis, flavors is absurd, as you know.
Well, it's not absurd because there are gradients to everything.
Yeah, exactly. I think both can be true, not at the extremes.
Right.
But
So, of course, I completely agree with Chris. And if anybody's been banging on about this for decades,
sure,
he and I have, there is no alternative to the dollar as a global unit of commercial exchange. Forget the reserves for a second. That's a semi-impractical.
Just as a shekel between.
Yeah, it's a
partners.
Semi-impractical thing, reserves, because what central banks decide to hold or not hold is ultimately secondary to what is the unit of commercial transaction. And there is no alternative to the dollar as a unit of commercial transaction at scale. There's nothing even close. It's not even remotely a point of conversation.
I mean, China would have to open up their current account. They'd have to allow a major yuan depreciation.
I mean, we're talking like
Europe
or the
doesn't have
Spanish, Italians, Germans, and British would all have to align into a single United States of Europe with a central bank and all the rest. It's just
and grow themselves markets that are at all adjacent to ours, which would take them forever and a half.
So why are we not buying the dollar at this point? I mean, it's ridiculous. The move is
because ridiculous. There are gradients to these things. I don't think what we're looking at in these moves is a genuine belief in markets that there is an alternative to the dollar because the markets are not dumb. And that's a dumb argument. There is no alternative. And
I think the gold chart says that the market thinks that there's no alternative to the dollar. I think that's what gold is telling you. This isn't a euro. Because people are reaching.
This is uncertainty. Something. It isn't viable alternative. I mean, the euro is soaring also, sure. The yen is soaring also, sure. These are the most liquid forms of cash, not named USD.
Yeah, but the difference between those is that the yen is up 10% year to date. Gold is up 10% over the past week. Right. So like there is a flavor where people aren't saying, I'm just going to get away from the dollar and go into other currencies. They're going into other currencies. Maybe it's repatriation, but they're also saying, I got to put my money somewhere. And this shiny rock offers me much better earnings potential in the short term than anything else I can put my money in.
Well, and it's anything not USD. And what more traditional of a dollar foil is there than gold? So the whole thing, I completely agree, isn't speaking to the dollar's replacement in global commerce, because that's a ludicrous thing to even surmise. But it does suggest that there is sovereign risk getting built into US dollar denominated assets, and that sovereign risk is getting discounted across the spectrum. So bonds are lower, stocks are lower, dollar is lower. It's a movement of capital out of the US because of a increased uncertainty in what doing business looks like in dollar terms.
Well, here's the good news for stocks in terms of where we turn around from today. Maybe it has to do something with expiration flows, but the area that we had previously marked up on the chart right near 18,000, that's been somewhat of a line in the sand, overshoots and undershoots on both sides for support and resistance. We do turn from there a little bit today. So, the worst.
It's why I didn't sell NASDAQ or the S&P today. We established those ranges on the last time that we tested it last week. So we had that big, he's paused the tariffs for 90 days. No, he didn't. He paused the extra tariffs for 90 days. Everybody still gets a 10% tariff, and the average before that was like 2. So this is still 5 times worse than it was before pause or no pause. But okay, fine. Yes. Okay, fine. So it's pulled back a little bit, and we established that sort of axis there. Former resistance becomes support, and said you got to get through that in order for this to be a sell again. Both S&P and NASDAQ, they're holding it. I got short the Russell at the end of last week because it actually took this out. And that seems to be working a little bit, but only a little.
Yeah, the Russell today is holding in there. It's been really the loss leader during this whole tariff episode, but it's those chip stocks today that are getting hit the hardest. AMD, again, with its $800 million charge-off related to the tariffs. NVIDIA, likewise. Their current generation of chips are the Blackwells. The prior generation was known as the Hopper. So they had these things called the H20s that they design effectively to be able to export to the Chinese market to work around the Biden chip curbs. That way the best chips aren't falling into, getting into China. Okay. Trump's changes basically say, you can't even export those now. So there's really no other market for these because other countries have the ability to get the new top of the line Blackwells. These export curves are only really aimed at China. So who are they going to sell them to? They've just had to decide to, we're going to write down the inventory. It is a healthy part of their income, somewhere around 7 to 10%. And the stock takes a haircut of about 6.87%. Today was a little bit worse for the wear. Dylan, this feels like an emblematic day of what we should expect. This is going to be the headline that marks the news for the foreseeable future. Major companies are going to be telling us that they have to write down things because of this trade disruption. We're going to hear from the small businesses that are going to have to go under as a result of these trade disruptions because the deals just aren't coming together yet. We still have nothing announced.
And it's going to be months. Obviously, there's not going to be any deals in the near term for anybody to do anything that's reliable, that's worth anything. It's going to be like this for months. I think that's the most likely path.
Well, and we're going to be kicking this 90-day thing down the road for all eternity because now this is a leverage point. Am I going to extend it? Am I not going to extend it? If he was just going to do it and take the Band-Aid off, first of all, that's not his style, but second of all, that removes all leverage. The pain is there. Now you just got to go and react. But now he has leverage. He can go out there and say, oh, maybe I'll delay him some more. Maybe I won't. And we can play this game constantly. So he has a button that he can push now, and he can basically threaten everyone with pushing it again. So we're back in limbo. But of course, for markets, that limbo is exactly the wrong thing. I think that's ultimately where you land with the Fed. Powell said
but here's
today.
So go ahead.
Yeah, so Powell said today, look, these tariffs are higher than Smoot-Hawley. There's no baseline of experience for what this is going to do. We're moving away from our goals. We're basically paralyzed. We'll see what happens next year. In other words, he almost seems to be goading the president to say, well, you want rate cuts, but we can't cut rates in this environment. You need to give us the ingredients. If you want us to do this, we're not going to do it unless you give us the ingredients. What's interesting, though, is all of this uncertainty is the place from where the economic hit is coming from. It isn't the tariffs as such. They haven't even shown up, really, in so much as sort of their hitting activity other than boosting it. We saw it in retail sales. The autos component and the auto parts component was off the charts because people are trying to front run the tariffs. It'll all fall off a cliff later. But as you look at all of this, so far the tariffs are not actually showing up as economic pain because of the higher costs. They're showing up as economic pain because of uncertainty and people holding back money that they would have otherwise spent. So this is the thing for the Fed now. Powell out there was saying, oh, well, if the tariffs are longer lasting, inflation expectations might get anchored. Inflation expectations are falling. And they're falling because people are looking through the tariff increase as a price adjustment and to the recession that adjustment will cause. Mm-hmm. The Fed just needs to come around. It just hasn't seen enough scary data to sell it yet.
That, I think, is the most noticeable part of this whole Powell comment today. I have it marked up here with the vertical line in the chart when he starts speaking. He said that we may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. And tariffs, he says afterwards, tariffs are likely to move us further away from our goals, probably for the balance of the year. So that confirms our prognostication that if the Fed sees a scenario where growth is falling off, but they see inflation getting back to potentially 5%, they're stuck. They can't cut rates there.
Their hands are tied.
And I actually
which seems to be the most likely outcome. I mean, that what you're describing seems to be the highest probability situation.
But
the markets, for their part, are saying that the recession impulse is going to be stronger.
Yes, right? Powell said that's going to be temporary rise of inflation. Again, we do the whole like you're going up, you have a shift, you keep going at that rate, so you don't really think about the tariff impact. You're more concerned about the real decline in economic output. But he says today, because these are bigger than they even anticipated when thinking about prior remarks, the inflationary effects could be more persistent. So, Ilya, I really, you said he's framing this in a manner with which you could argue he's laying out the case for what Trump needs to do in order for Powell to start cutting.
Yes.
I didn't think of it in those terms. That's a really interesting perspective because he effectively says, look, you just give us some certainty, we can more probabilistically, with a higher probability, assess this outcome here.
Yes.
With more certitude. And then we can start to make our moves to make the adjustments that are necessary. But until that happens, we're kind of just stuck.
Because they're telling him they want to cut. The Fed has been saying that it wants to cut this year since before Trump took office. In fact, it's been saying that it wants to cut this year before the election. That was, I think, a really deft move on the Fed's part. I've called it sort of like Fed judo, where rather than fight the markets, they lean into where the markets are pulling them and throw the markets off balance. So the markets wanted the Fed really dovish from, let's say, mid-April to early August of last year. And in September, the Fed gave it to them. But of course, by then, the markets didn't want them to be as dovish. And so the extreme speculation flipped because now all of a sudden the Fed looked like it was offsides and the markets went, oh, well, they gave us what we wanted in August, but now it's September and it's a new day. But by then, the Fed had laid out this big, expansive, dovish case for both last year and this year. It opted to front run anything like any pressure from would-be another Trump administration, because in September, obviously, we didn't know yet for certain. And so the Fed said, look, 2025 is a year we're cutting, and we're cutting a lot. We're putting that on the table now for our reasons, to sort of take away any veneer of we're being pressured, the president is leading the Fed, anything like that. It's a very smart move to sort of get yourself out of, well, we said this before we even knew that he'd win. And then, of course, he wins. Fed sticks to its guns. If anything, gets a little bit less dovish as you get into the December SEP update. They uphold it in March. So they're looking very much, or wanting to look very much like they are existing outside of what the president wants.
Okay, so
pushing them to do.
Dylan, counterpoint. Fed Chair Powell gave Biden and Harris a gift with a 50 basis point rate cut in September, effectively signaling to the country that the inflation scare was over. Trump came down hard about that rate cut. Now,
well, he should.
Now he's demanding rate cuts, and Powell's saying we can't give them to you. When does Powell's job become a question that's talked about?
But hang on, there's a critical. The difference is that the inflation data was what it was. There was data in September that supported that rate cut. Mm-hmm. And there was not the presence of a chaotic, extremely high, maybe tariff regime.
Yeah.
So when you're saying that this is ultimately politicized,
so I just think you're not comparing it. There's a before, there's a BC and an AD here, which is before Liberation Day and after.
Yes.
In terms of economic.
Well, and everything else. I mean, the Mexico-Canada shuffle too.
Yeah,
I know that. I think it's worth explaining that because I know that we're going to go. I have this like my spidey senses tingling. We're about to go into a very stupid news cycle where Powell is being criticized for being political because he's refusing to give in to Trump's desire for a rate cut right now. But he's making the case for one. He's just saying he can't do it. His hands are tied either way. He's not even articulating, if you go down this path, I'm going to have to hike.
No.
He's saying we can't do anything at all whatsoever right now. So Give us some clarity. And it's a perspective that China pushed out into the media this morning as well. There was a small tweak to the Trump tariff package that was announced yesterday that brings up on some goods, in particular medical devices that are imported into the country, tariff rates up to 245%. It's not all goods at 245%. It's some. Nevertheless, the Chinese government put out a statement saying that they want three things from the Trump administration in order to begin constructive dialogue moving forward. One, demand for respect. Two, unified U.S. messaging. And three, a singular point person to oversee trade talks. They're particularly bothered by J.D. Vance's comments where he referred to, people living in China as Chinese peasants, which if you've, looked at any photographs of any of their major cities right now, they've urbanized a lot very quickly. And I think the source of all of this discontent is the fact that, China makes better cars, computers, many things better than us right now. And we want to get that back here and lead the world again in those areas. But Dylan, make a market for me here. What are the odds that all three Chinese demands in a form and fashion will be met? Because it feels like, oh God, I'm going to say this and regret this. It feels like China and the Fed are in the same camp.
I think everybody's in the same camp. Everybody everywhere is saying, we don't know what's going on. Won't you please explain it? Everybody is in the same camp. Absolutely anybody observing this thing is in the same camp. They're sitting there like this and going, I wonder what that means. And I wonder if it'll still mean it tomorrow.
Okay. I'm gonna take the other side of this whole thing.
Okay.
Whole thing.
Here we go.
There's a clear plan. Okay? There's
You lost me. You lost me.
Hear me out. It's a clear plan. Act 1, tariff crazy ball underway. We've seen it. We know it. We love it.
Yes.
Somebody will get a tariff. Somebody won't. Who knows? Markets will get wild and woolly. It's fine as long as the bond market doesn't go super freak. This will be yesterday's news soon enough. But think of it like loosening. It's like breaking up the ice. It's like sort of making the environment more malleable. Okay, you're just creating a little broken material. Act 1. Act 2. Who knows when Act 2 is, but sometime in the next, let's say, sometime this year, between now and Christmas. Entirely new tax regime. Income tax reductions across the board. Tariffs are going to fund everything. That will be the story, even if it's not true. Tax cuts for everybody is Act 2. I won't get into the details of whatever that means. Enjoy yourself. So their plan is tariff madness, Act 1, tax cuts for everybody, Act 2. Marginal increase in domestic manufacturing. Marginal decrease in domestic consumption, Act 3. Restructured, more stable, more resilient, less vulnerable U.S. economy, Act 4. Takes a few years to get there. Act 1, tariff madness. Act 2, tax cuts. Act 3, shift in reduce consumption, increase domestic manufacturing. Act 4, domestic stability. Trump should hire me.
Problem is,
for a speech like that.
It doesn't work. Problem is, it doesn't work and can't.
Well, how do you get from step? How do you get? Let's just entertain this. Let's steelman this.
But I'm just saying, this is their story. I'm not. No, all jokes aside.
The story is a good story.
Sure. So what are the practical steps then? So we're having the tariff madness 1. Okay.
Tax cuts are coming, big ones for everybody, sometime later this year. That's
farmer bailouts. Okay, so we're in between steps 1 and 2. We have to fill in the gap now.
You're dealing with the unpleasantness of Act 1 to set up the relief you're going to have when I just when the benevolent king gives money to everyone, tax cuts and bailouts.
Tax cuts and bailouts. That's a tax cuts for corporations.
So the deficit. The deficit blows out.
And just job losses for small and medium-sized enterprises in step one. So we get to step two. Corporations have tax cuts, which, as a small business that's no longer in business, you can't enjoy. So get in the bread line. So we're in step two now.
Deficits have blown out. Yields are already surging because of the uncertainty. Now they're surging more because the deficit has blown out, and because you no longer have the built-in exorbitant privilege because you've created the uncertainty to mess that up. But now everybody that's waiting for the new and empowered tax cut bonanza is also saddled with massively higher yields. And so for them, dealing in any kind of form of economic activity now costs X times more to finance.
I really don't like the CCP, to put that out there in public. I think I've made that clear before. Not a fan of communist governments. If China gets
former Soviet, I can't but agree.
If China gets what it wants from those 3 points of demand, Dylan, I think your world actually becomes a lot more feasible. Right? If there's clarity, if there's a point person, if you get Lutnick off the screen, right? If it just becomes a singular individual, it becomes a more controlled process. Maybe that person's trying to process. It becomes a process. Yeah, right now it's not a process, right? You can't see the lights flashing on the runway. The fog is too thick, so we're still circling. We need some sort of lights on the runway right now.
Any process.
But that process would be good.
And a process also then gives the Fed what it wants so that they can start cutting rates. And if they start cutting rates, Dylan, that's how you get that boom with deregulation and tax cuts. Because now as the tax cuts arrive, the Fed is providing support to a market that already is dealing with a drawback in aggregate demand.
And let's presume that's the Trumpian vision of the next 18 months.
But there's that key step that's missing first before in between step 1 and 2, which is a plan. And there's very clearly no plan still, which is the hardest part.
And also this whole bringing back of manufacturing thing becomes an absolute pipe dream because you've jacked up interest rates on everybody as a consequence of all of this. You've made money expensive. There is no certainty to go and lay out any kind of reshoring program, which takes years to take hold. Years more to employ people.
Forget the reshoring. China is seeing the same thing that we're going through.
Yeah.
Manufacturing as a percent of China's GDP has gone down over the past 20 years. It was 32% of the economy in 2004. It's now sitting at 26% as the end of 2023. And yet their manufacturing footprint has grown in ways where, how come they're exporting so much more stuff to the world? It's automation. And their economy is also evolving. As it's maturing, it's becoming less manufacturing dependent. And that is in part what's happened to us. You know, what really stands out is people say like, oh, we've lost all these jobs in manufacturing since NAFTA. That's true. But in terms of supply chain logistics and office and ministerial jobs, which typically have lower rates of physical incident than working in a factory and usually higher pay, we've added 15 million of those compared to the 5.5 million manufacturing jobs lost. So my big shtick here, guys, is that what the manufacturing jobs represented in the 1970s, 80s, and 1990s was job security and a wage premium that you had by not being in a union. And manufacturing had the highest unionization rates of any field countrywide. So we're talking about a decline in manufacturing and the hollowing out of the middle class. We're lamenting the decline of unionization because that's the stability that it provided. And That's
right. But,
but also,
can we actually go to a slightly higher altitude here? Like we'll go from 30,000 to 60,000 or 80,000, which is the reason that there is political dysfunction in the United States is because there is incredible dissatisfaction and a perception that there is that there's two classes of human beings in America. There are those who are in the laptop class, whether they're tech, whether they're finance, whether they're Hollywood, whatever it is. And then there are those who are not, whatever that means. That was really clarified. It really, the break, I would say, goes back decades, NAFTA, Clinton, but it propelled in the financial crisis and then codified with COVID, where the so-called emergency workers had to go to work every day. Essential workers was like F you, right? Like it's like you get applause and $10 and you got to go to the hospital, or you've got to go to the police station, or you've got to go to the gas station, or you got to drive the ambulance or whatever it is, while the laptop people zoom it up and go to whatever that app that was popular, Clubhouse, I think it was everybody's going to like whatever, like what's going on over there, buddy? Like that, all of that is the underlying reason why Trump is the president of the United States.
Well, I think a lot of people have said this now, and Jon Stewart may have been the first, but that what Trump is really good at, what he's really excelled at, is identifying the correct problem. The issue is that the solutions
I agree.
Take us right.
What would you do?
We have to be able to hold both of these ideas at the same time.
It's easy to sit in the peanut gallery. I'm one of the kings of it, and explain why this is idiotic.
Right.
It's low-hanging
this is the whole thing, is that
what would you do?
The problem is identified correctly. The issue, and we can talk about why the problem is
universal basic. What's the solution? What would you? So Vecchio is going to say stronger unions. That's it. I can see where he's at.
I think that unions are strong, but how are you going to convince people just to all of a sudden like unionize? That just doesn't happen.
I don't think there is a magical wave a wand silver bullet solution.
And to be clear, Dylan, my position is that the old ways are dead, and the world that we grew up in is gone.
So we're all going to agree to that.
That's right.
It's going to be worse because ChatGPT is now going to take out the laptop class. All the marketing people, all the lawyers, all the financial advisors are going to go the same way as the factory workers.
Well, and this is really the whole thing, is the reason we have this issue to go 900,000 feet bird's eye view. We had a massive government driven boom in the 1950s because we were coming out of the Depression and we fought a war. We then made it bigger with more government spending, with things like the GI Bill, and had a massive
and we invented the 30-year mortgage, for God's sake.
Well, and had a massive economic boom.
One of man's best inventions, Dylan.
We had that economic boom because the government bought it. It then also created massive inflation that we had to fight in the 70s. That massive inflation then gave us the 80s, where we had to deregulate and focus on efficiency to bring inflation down, in conjunction with what the Fed was doing to hike up rates. All of the Reagan Revolution was about disinflation. It was about moving everybody to the lowest possible cost structure because the fight was with inflation. That helped everyone, but it had costs. And the things that we didn't do in going to more efficiency, in going to more globalized markets, in broadening the WTO, which successfully destroyed inflation for 40 years and gave everybody cheap credit and gave everybody stable growth and, again, a booming disinflationary economy, was we didn't take care of the people in the minority for whom the costs outweighed the benefits. What we're doing with these tariffs is like a bizarro mirror image of that. We are hurting the majority to help a minority. Exactly. This is not the path to success. The path to success is to now look at AI and go, we're not going to make the mistake that we made with opening markets. We are going to try to spread the benefits even to those people for whom it is a net cost.
But don't you think the situation is even more existential to go full?
It's just
Mark
the next
Andreessen,
thing.
To go full Mark Andreessen or Andrew Yang or whatever, we are moving to a world where you need a different economic structure because
nobody knows that.
Conventional ideas of work are going away.
Absolutely.
Sure, but that's always been the case. Anytime there's a major breakthrough, it changes the nature of work. It changes the nature of employment. It changes the requisite skill sets.
He's not talking about the nature of work. Capitalism is a system that's about distributing finite resources. We may be We're moving into an era where we may not have.
That's very Malthusian of you.
Such finite resources moving forward, and so if you have an entire system about supply and demand, and supply is less of an issue because there's abundant energy, right? Then you have to have a different economic system. Where you have to reweight it in some sort of fashion so that people aren't left behind.
If you have basically unlimited supply of resources, but access to those resources is controlled by a tiny group of people.
Yes,
that's the situation you find yourself in. That's where I perceive the overall trend to be socially, which is what Trump is exploiting.
Well, and I
think Trump is honestly, and I would even argue to Navarro's credit or Lutnick's credit or Bessent's credit, even though I think they're completely batshit crazy and wrong, I believe that they are trying to rebalance the economy, even though I totally agree with you, Ilya, that what they're really doing is punishing everybody for the apparent benefit of a few people, which is just catastrophic for everybody at the end of the day.
That's
but I do think that they think that they're doing something useful.
No, sure. I don't doubt their.
And they're like, I don't work for you, Wall Street. I don't work for.
Their assessment of the issue
or Milan. I work for Kentucky and Mississippi. I work for the people that voted for me. Look at the map.
Their assessment of the fact that people are upset at certain things and their assessment of what those things are is clearly correct. Whether you can question their intentions or whether they know that they can't do it with this and they're doing it anyway, who's to say? I think taking them at face value is what makes sense. And until something suggests otherwise. I don't think that we're going to reinvent capitalism.
Guys, Trump is the most skilled politician of our lifetime.
More than that, he's the greatest salesman ever.
Yeah, growing up it was Reagan, right, and FDR are like the two names that stuck out to me, and then maybe Clinton gets in there just because of how he ran a full employment economy with a booming stock market.
I mean, last gasp of the Reagan revolution, as it were.
Right, like Obama was pretty inspiring.
The peak of the American Empire was probably 99 or 98 or something like that.
Last peak. It's a trend. Yeah. There'll be a higher high.
Growing up in the 90s, man, you're like, oh, so we won everything? We won everything? Oh, cool. And then 2001 comes. But Trump is probably the most skilled politician of our lifetime, and that's the one thing. He's very apt at identifying the problems. I just think his solution is tends to be bad. That's kind of where I sit on this.
And this is really the next. This is the fodder for the next reinvention, right? We first had to reinvent ourselves from being our agrarians to being a manufacturing economy. Then the world wars happen, and it turns out we have the only factories and Europe is bust. Of course we want free trade in that environment. We're about to get rich. We're about to go rebuild Europe. They have nothing. Our factories are untouched. We're about to go make this money, baby. What? Of course, free.
Dylan, every night
Of course,
before
the trade is open.
every night before Ilya goes to bed, he sends me a text. To get to FDR, we had to go through Herbert Hoover. Every night. No,
That's
so
right.
speaking of hysterics.
That's not a good
by the way,
I mean,
I tweeted about this
life
today
is
going,
short,
oh
people.
no,
Life is short.
I got to cover my
what happened?
dollar shorts.
I mean,
Dylan, speaking of life is
Okay.
short, maybe we've been too hysterical here. One of our favorite indicators in the world, The Economist. Great. I love the reading. Insightful, sharp commentary.
what's the dateline? Is that April 19th?
Oh, that's
this week.
That's this week's episode.
That's about to be the cover
That's
this
my
week.
birthday, by the way. Thank you very much. That's a birthday. That's a birthday cover. That's got to mean something. I'm buying the dollar. I don't care what you guys say.
I think actually that's where we're going with this right now, Dylan.
I mean, I'm sitting on my shorts and I'm not
It's
adding
my
1
birthday,
cent
for
to them.
God's sakes.
I'm just waiting to get out now.
So The Economist has this penchant for. Tom talks about the public, right? Like, oh, you're too public. You have a very common perspective, common point of view. The Economist is like the public in the macro world. If it hits the Economist cover, it's been percolating for a few weeks, a few months, and you're probably at a sentiment extreme. In this case, I think the cover speaks for itself, how a dollar crisis would unfold. So one thing that I'm doing here today, with respect to that, I'm waiting. I couldn't get filled earlier. I am currently trying to exit my long yen position that has 23 days to expiration, the James Bond trade, as we like to call it around here. Some people were doing the long 007, 0071s. Some were just doing the long 007 calls. That has been fulfilled. So I'm looking to roll out up into the long 72, 73 call spread with about 61 days to go. The yen looks pretty good, but there's also the notion that there could be a Japanese-U.S. trade framework announcement somewhere around the corner. Trump is a guy of the 1980s. I think of like Trump as emblematic of the 1980s in my head, right? I think a weaker yen would be part of an agreement, or a weaker dollar with respect to the yen. A stronger Japanese yen would be part of the agreement, right? Because
Almost
Trump,
like a Plaza Accord again, that kind of thing.
Yeah, because there's just this part of me. I you look at how he talks about Japanese imports and how we don't have access to their markets and how we need to open up those markets to sell our cars there. You open up the markets for our car sales, you're also going to want a stronger local currency, so it incentivizes Japanese consumers. Hey, my yen is strengthening versus the dollar. I should buy and import one of those American cars. If all of a sudden the yen collapses after they open up their markets to our vehicles, is it really going to incentivize the purchase of bringing something in from abroad? No, it's going to be more expensive. I think the yen still has some ways to go here. And if bonds are stabilizing, then rate differentials certainly do not help the dollar versus a currency like the Japanese yen. I'm making an adjustment here today. And I suppose the other one is what to do with gold.
What adjustment are you making?
Taking profit on the current call spread, rolling it out of the money, and getting myself more duration.
Okay.
Gold obviously has been a question here. I've seen a few people in the chat say, they're staying long over the course of today. Yes. Staying long gold.
Getting a little funny, though.
It's feeling a little blow-offy.
Getting a little funny now.
Ball's also going up. If there's nothing that I haven't been, well, the one thing I have been, I should say, is that I've been very consistent how I feel about selling calls in gold. Not for me. Never, ever. I wouldn't fade this. I still wouldn't fade this. I've been saying that all year long. I'm not a gold bug by any stretch of the imagination. Ilya, you know that better than anyone.
Oh, yes.
But this is just you couldn't, Dylan, if you and I were to sit down in a lab and design the perfect environment for gold, this would be it. This is like the gold bug dream scenario playing out right now.
Shouldn't this also be the dream scenario for Bitcoin?
Yes. And that is one of the noteworthy...
If you thought Bitcoin is like gold, then yes.
No, the fact that Bitcoin is holding up so well today compared to the rest of the market, Bitcoin itself tends to track the global M2 money supply with about a 6 to 9 month delay. And because of the dollar's weakness, all of these other currencies in the world have gone up, which means these central banks' balance sheets have inflated in relative value. So measured in dollar terms, the global money supply actually is screaming higher right now. And if we're out of a liquidation phase in Bitcoin, I feel comfortable saying that if we had to make a bet what's going to come for 65K or 105 from these levels, plus or minus 20K, I bet on the 105. I think that Bitcoin is on the precipice of a major turn, just given how these things have gone in the past. And if it follows its typical cadence, we should be looking at new all-time highs soon, maybe within before the end of this quarter. And I'll be acting accordingly. I think I just got filled on something. That's nice.
I will not be acting accordingly. I will be looking at other vehicles, but that's not because I don't agree with the assessment. I think the assessment makes a lot of sense. It's because I don't believe in the asset class in general. But looking at what's going on here, yeah, I mean, I think gold is starting to look a little blow-offish. If you look at the momentum indicators there, they're starting to show some very eye-catching negative divergence. As you set these blistering highs, that's typically not a good sign. That suggests momentum is fading. You look at the dollar, and it's still selling, but it's getting to kind of, again, weird levels of apparent exhaustion. You see the bonds start to unclench. So maybe if the bonds are unclenching, then there is a little bit of that term premium coming out of them relative to kind of peak hair on fire last week. And if that's occurring, then you should see a little bit more of a readjustment toward the dollar and away from gold. That gold surge is basically the same thing as the term premium in the bonds surging, identically the same move. So maybe you're getting to a place where this can release a little. I don't really expect the dollar to make much hay of it for a very long time. And if there's any kind of pull up, I'm going to be, first looking to get out of my shorts, but then looking to reload on those shorts. I'm not a buyer. Because then you get a more normal dollar. A dollar inspired by yields. And that's not supportive. But maybe there's a correction here before that occurs.
Dylan, earlier you mentioned in your, if Trump gets his way, right, he's able to restructure the economy and get the deregulation and tax cuts, like, can we replace income taxes? Can he provide? And I've seen this floated out here.
Back to his tax cuts. This is a prosperity strategy based on tax cuts. Anyway, you know what the theory. I'm not going to repeat it.
Well, one line that has come out in recent days is that the money generated from, or the revenue generated from the tariffs will replace income taxes for people making less than $150,000 a year, which is a completely different story than saying we're going to replace income taxes altogether with tariffs. You'd have to have an effective tariff rate at 58%, and that assumes no retaliation from any other countries whatsoever. That's obviously not happening. Well, maybe not happening. Let's go through some of the trade war headlines today, though, that are currently sitting on the top of CNBC right now as we think about this, and then end with a little bit of math. First story, tariffs won't lead supply chains back to U.S. as companies go low tariff globe hopping, CNBC survey. Second story, trade war fallout, cancellations of Chinese freight ships begin as bookings plummet. Third story, Trump tariffs on China will soon bring irreversible damage to many American businesses. Fourth story, if companies start citing Trump tariffs and price hikes today, they're taking advantage of you. Here's why. But this is the one that really, the math, can't escape the gravity of math sometimes. Trump's been claiming that we've been collecting $2 billion a day in revenue from the tariffs that he's implemented so far. The Customs and Border Protection Agency and the Treasury Department list this week the revenue that's been collected under the new tariff regime since April 5th. And according to the Trump administration, CPB has collected just over $500 million under the new reciprocal tariffs. Total. altogether. So, Dylan, I would tell you, if you think, or anyone thinks, rather, that we're going to use the tariffs to replace the money generated from income taxes, which income taxes north of $6 trillion a year, the math just doesn't work out. And if we do push for that, it's going to lead to the U.S. budget deficit exploding. We won't, the numbers just don't work. So I think that, are we out of the woods yet? Nope, the NASDAQ told us that today. Bonds, though, stabilizing is the most comforting aspect of all. And if you want resources or understanding of why that may have happened, look to the 20-year bond auction. The 20-year bond auction was very strong today. Stopped through, which is really nice. And, of course, strong foreign demand. So countries aren't stopping showing up right now. And I think that's an important aspect to all this. In any event, guys, thank you for letting me drive on here into the close. We're now done here for Wednesday. We'll be back tomorrow, same time, same place. As always, for Dylan Radigan in Milan, Ilya Spivak in San Francisco, I've been Chris Vecchio in New York. Stick around, of course. Ilya Spivak's up next with Macro Money. He's also back on with Victor Jones tonight for The Price of Truth.
Indeed.
We'll see you after the break.
See you there, everybody.
Got trader's block? We've got the cure. Get data-driven trade ideas with Cherry Picks, our weekly newsletter that gives you insights into the market. Sign up at tastylive.com/newsletters.
Woof! The first half of this year's market has been giving the good guys the business.
It's certainly been back and forth for sure, Pete, and I'm getting whiplash over here.
With good mechanics, we can see Team Tasty stay strong in the second half.
Absolutely. Let's check out our starting lineup. Nikki Batt, University of Kansas. Number 20, because that's how many underlyings are in my portfolio.
Rick Welch, Illinois Institute of Technology. Number 23, because I'm trained 23 hours a day.
Dr. Data, Louisiana State University. Number, square root of 1 over 365, because that's the square root of time for 1 day, which is multiplied times the stock price, multiplied times the implied volatility, which gets you the projected stock price for 1 day.
I like the looks of that lineup.
Well, be mechanical is always better than just trying to run plays to see what sticks, Pete.
When you got skin in the game, you stay in the game.
That's right. Now get off the couch and get into the game.
Watch Tasty Trade.
I bet you work a lot of hours.
Yes. I bet you can't guess how many hours a week I work.
Really? Mm-hmm. 60.
61.
Oh, God.
$1,000.
So
Boom!
close.
Oh,
So
my day
close.
is starting out great. Want to go double or nothing?
Let's see. What color are jeans?
Blue.
You got it!
Common color of jeans. They write songs about it.
I thought it was tough.
Double. I win double.
Great job.
Yes, and you get nothing.
I'll pay you in love.
That's not how this one works.
I will pay you
No.
in hugs and kisses.
There is no hug and kiss worth $1 million. Cool.
I could make it worth $2 million.
I've kissed you before and it's not that good. Woo! This is what I love. Every time the game hurts you, she gives it right back to you.
What do you mean I don't kiss good?
You're awful. You're very mouthy. Man, this feels good. Oh, this is why I do it. All right, come on, let's keep going. I'm on a roll right now. What's the matter?
I didn't know I was mouthy.
You think it would be good, but it's not. You should practice more.
Okay, my turn.
Okay. Try to make a little money back?
Okay, you want to go big?
Yeah, let's go big.
I'll get it on this man's game. I'll get in this man's game.
Yes.
$5 mil.
$5 million?
$5 million and a speedboat.
A speedboat?
Uh-huh.
This is serious. Yes, I'll take the bet.
Okay.
Oh, boy, here we go.
I bet I know the name of your childhood friend.
Nobody knows the name.
Really?
I never talk about him.
Oh, really?
Oh.
Lenny Cancelleri. Bam!
Woof! The first half of this year's market has been giving the good guys the business.
It's certainly been back and forth for sure, Pete, and I'm getting whiplash over here.
With good mechanics, we can see Team Tasty stay strong in the second half.
Absolutely. Let's check out our starting lineup. Nikki Batt, University of Kansas. Number 20, because that's how many underlyings are in my portfolio.
Rick Welch, Illinois Institute of Technology. Number 23, because I'm trained 23 hours a day.
Dr. Data, Louisiana State University. Number, square root of 1 over 365, because that's the square root of time for one day, which is multiplied times the stock price, multiplied times the implied volatility, which gets you the projected stock price for one day.
I like the looks of that lineup.
Well, be mechanical is always better than just trying to run plays and see what sticks, Pete.
When you got skin in the game, you stay in the game.
That's right. Now get off the couch and get into the game.
Watch Tasty Trade.
Tom, when you're scooping the offer, what are you doing?
That means when you're scooping the offer, you are buying whatever you can get your hands on at the best available price.
What does it mean when something trades by appointment?
Trading by appointment is when, like, you're in a pit back in the day that had like 1 or 2 market makers in it, and if they were having lunch, you had to make an appointment to make a trade with them.
In the pit, if you said, I'm going to buy your book, what did you mean?
If you're going to buy the book, that means you're going to buy everything that is posted in an electronic book. So every resting order that's posted in the book up until a certain amount.
If you say take a fill, what's happening?
If I'm taking a fill, that means I'm a broker, and if I'm a broker, that means I did something horribly wrong because I'm a market maker. I got Joe in Houston. What's up?
Just want to call in and say I really appreciate everything. I started trading and learning from you guys about 6 years ago. You know, it was you guys' work and the platform that got someone like me that didn't really know anything about the market capable of really outperforming the market now for, 5 out of the last 6 years. And so I really appreciate you guys. And I can't think of another company where I can pick up the phone and call the CEO, the trade desk, and reach somebody as quickly as I can there. So just really appreciate everything and what you're doing for guys like me out here. What you're doing is really spectacular. So really appreciate it.
Thank you, my friend.
I really appreciate it.
You made my weekend, man.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and tastylive web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
The markets are still smarting from last week's tariff news, at least looking at stocks. Bonds are starting to find some kind of stability, but the real screamer seems to be happening in currencies, where the dollar is getting absolutely trashed. What's going on there, and has this market gone too far? That's what we're going to unpack here on Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And of course, the situation all is connected across the various markets. This is all the same uncertainty and all of the same issues that we see playing out here. But of course, the big question still is whether the moves have become overextended. And you're starting to see a little bit of that sort of unease and lack of conviction start to play through what you'd think are the big benchmark markets. So stock markets have a seesaw week last week, but ultimately they are off their lows, and we're seeing the S&P 500 and the NASDAQ and the Russell start to anchor a little bit toward the middle of last week's range. The bond market has seemingly started to even out a little bit. Bonds are off from last week's lows in the U.S., and yields have pulled back a little bit. But the situation in currencies continues to look precipitously bad for the US dollar, and we can see that here. This is the dollar's performance against a range of currencies that mark the four top counterparts, looking at data from the Bank of International Settlements. And what we have here is the yen, the euro, the pound, and the Aussie dollar. And we can see the yen is narrowly outperforming, up 10.7%. The euro, very close second at 9.6%. The pound is lagging, up almost 6% year to date. The Australian dollar last in line, starting to approach a 3% gain for the year. Now, what's really interesting about all of these dynamics is, of course, how they've reflected a shift in markets around this tariff news and the uncertainty therein. And probably nothing captures this more than the dislodging of the usual trade patterns between the dollar and the euro, because if the yen is more a creature of yields and Japan is not exactly the place where normal monetary policy, at least relative to other central banks, has held sway for decades. Of course, had interest rates near zero in Japan for decades on end at this point, close to 4 decades, because of the demographic impacts of an aging population, peak consumption, and the absence of inflationary pressure, and a central bank that desperately has been trying to rebuild it to restart growth. That aside, the sort of most normal, most textbook relationship in the currency markets is that of the dollar and the euro. And the euro, we can clearly see, is absolutely soaring here. But the reasons for its moves have strangely decoupled from the norm. So looking back, we can see here the trajectory for Euro USD is very closely tracked in recent years with the 2-year spread between Germany and the US, essentially saying this is about relative monetary policy. When the Fed seems to be more dovish relative to the ECB, the dollar weakens. When the Fed seems to be more hawkish relative to the ECB, the dollar strengthens. And so you can see here, when the yield spread moves in favor of the euro goes up against the dollar. When it goes the other way, euro goes down. But here, clearly, there has been a very important disconnect that's emerged just in recent weeks. Really, this goes back to the beginning of last week, where you can see there's this massive shift down in German yields relative to equivalents in the US, but the euro surges all the same and ends up at levels that we've not seen in years. So how does this make sense? Well, of course, one of the biggest stories here has been the massive slide in US bonds and the surge in yields that has followed. And that seems to have spoken mainly not to the expectation that the Fed would do something more hawkish, not to relative monetary policy considerations at all, as a matter of fact, and certainly not to the typical risk-on, risk-off dynamics, because, of course, against that backdrop, stocks have been mostly on the defense. They had one great day last week when the tariffs above 10% were paused for 90 days. Now, of course, tariffs still went up to 10% from an average of about 2% as a consequence of President Trump's quote-unquote Liberation Day. But at least the worst of the increases, above 10% on many countries' rates, at least that was paused for negotiation. But never, and of course that gave stock markets a big rally last week. But they've since given away about half of it. And the net story, obviously, for stocks since the beginning of the year has been resoundingly negative. And so it's not as if we're seeing U.S. yields go up and bonds sell off because there isn't a bid for safety. There is. It's not because the Fed is saying something hawkish. It isn't. In fact, we just heard again today from Fed Chair Powell saying that the Fed is in a situation where their goals of maximum employment and price stability might be getting in conflict because of these tariffs, to the extent that the tariffs boost inflation and at the same time hurt growth. The Fed is being pulled to cut rates on one side of that equation and to hike them, or at least to withhold cuts on the other. And the message from Powell was, until we see the economy really tilting to show us it's going this way or that as a response to these things, we're not going to feel comfortable making a move. We're going to wait and see. So this is not about that. What it seems to be about is an exodus from U.S. dollar denominated assets, where the drop in bonds, the drop in stocks, and a parallel drop in the U.S. dollar are all of a kind. And they're all reflecting the same general idea, which is that there is increasing uncertainty around U.S. dollar denominated assets generally. And what there is now is a capital exodus around that uncertainty from the whole lot of U.S. dollar denominated financial instruments. And indeed, we see that the term premium in 10-year U.S. Treasury bonds is now the highest it has been in essentially 4 months. So uncertainty is very clearly surging. Inflation expectations aren't. You know, the Fed is worried about them. They're actually down to the lowest since, give or take, late September of last year. So the markets appear to be looking through this whatever one-off increase to inflation there might be from the tariffs to the consequences of that increase. That is to say, weaker growth and perhaps recession. But the uncertainty quotient has certainly increased, and that seems to be driving an exodus from dollar-denominated assets as a de-risking exercise. And that is, in part, what is driving yields higher and pushing this down even as the dollar sells off. Moreover, the outlook for ECB monetary policy has become more dovish, which of course is a very curious consideration on the eve of a policy announcement coming at us in a matter of hours from the ECB's Governing Council and President Christine Lagarde. So it's very curious to see here that through all of this, the pathway forward for the ECB has become more dovish than the markets thought it was going to be at the beginning of last month and at the year's first policy meeting in January. And of course, that seems to reflect the same idea that we have in all of this tariff news flow a recession that is starting to show up as the path of least resistance for everyone involved. Now, we can see here that we're not quite fully priced in for a rate cut at this meeting, but that's probably a function of the monthly futures needing an adjustment because, of course, the meeting is happening mid-month. And so we probably are looking at the cut already in the market, and indeed most economists expect it, because if we look to June, we can see by then we're already off 45 basis points from the current baseline deposit rate, implying that not only have we had one cut here in April, we're very much angled toward a second one sometime by June and at the latest July. So it seems like we're almost certainly going to get a cut this week, and the markets are leaning in the direction of another one by June. It's certainly already discounted there in July. And as we get toward the end of the year, we can see that already come October, a third cut is pretty much on the menu. So if we look at the overall path of rates here, we can see that what's happened through all of this consternation is a sharp dovish revision to this year's monetary policy expectations. We now are looking at 72 basis points in rate cuts. That is, 3 cuts are pretty much on the board. What's interesting is that the outlook for next year hasn't changed very much, still holding at about 11 basis points. And that is, of course, on the upside of the ledger. So what that implies is that we have about a 44% chance at this point of a rate hike from the ECB next year. Now, just to give the situation its due and be rigorous with our evidence, yes, we have a dovish shift here in policy, in expectations for it, certainly. Could this be something other than just a read-through of trade war concerns? Well, on the growth side of things, doesn't seem like there is a particularly compelling reason to think that the ECB needs to get more dovish. In fact, growth has improved a little bit over recent months. It's come off from a contractionary area here. This is PMI data, and so of course it's centered around 50, which is neutral. Above 50 is expansion, below 50 is contraction. The further you go above 50, the faster the expansion. The further you go below 50, the faster the contraction. So we can see here that services are anchoring in positive growth territory at 51. They certainly haven't gone worse here in the past, let's call it 6 months. The situation in manufacturing has actually improved. The sector is still contracting, but at an increasingly lower rate. And that has allowed for the composite index that takes in both to return to about neutral, and then in the March numbers even come off that, show a little bit of upside momentum. So the growth picture does not seem to scream for more easing. Neither does the inflation picture. We just saw the latest update of inflation figures over the past day here, and what we can see is that, again, for March, we're down to 2.2%. We've been kind of cooling in recent months, the past 3 months or so, but we're very much in a range here, just above the ECB's target, and so does not look like this is screaming for a big dovish revision. However, if we look at what's going on with inflation expectations, these are German break-even rates, so the difference between real and inflation-adjusted yields, to give us a flavor for what that inflation adjustment is that is getting priced into the bond market. We can see there was this sharp jump right here, and that helped to fuel part of the euro's rally at the start of this situation. That looks to be this right here. And that seemed to be mainly about the idea that perhaps the U.S. security blanket is not so reliable at this point. Maybe NATO needs to arm up to do more of its own heavy lifting. Was, of course, a rapid race toward defense rebuilding in Germany, in France, in the UK. but most critically, of course, in Germany, where they went so far as to suspend their debt limit for defense spending in the new administration. So we have a jump in yields around that story here because, of course, all of the money they want to spend on defense will amount to some degree of inflationary pressure. But we can see since then, inflation readings have fallen off a cliff. And in particular, at the shorter end of the maturity spectrum, this 5-year rate has absolutely cratered. And this really speaks to the idea that the markets envision economic pain ahead in the relatively nearer term, that they envision some kind of a recessionary dynamic gathering steam downwind, even as growth now seems anchored, and even as inflation now seems anchored. And all of that seems to be giving us this adjustment in policy expectations toward a more dovish setting, and again, helping to explain how we have this decoupling even as the euro is surging. This, of course, sets up a very interesting setup for the ECB as it prepares to deliver these rate cuts. Because the rate cuts themselves, as we can see here, they're pretty well baked in. So if the ECB cuts this week and over the next 24 hours, then hardly anyone will be surprised. And if they lay the foundation for further cuts, hardly anybody will be surprised there because that foundation already exists. Indeed, again, we're looking for 3 cuts this year. And so the real question now becomes, what can the ECB say that meaningfully alters the status quo and helps to guide the next steps? Because clearly we're decoupled from the usual dynamics and looking at something else here as the main catalyst for what's going on. And from the ECB's perspective, of course, and the market's onboarding of that perspective, the key question is, what does the ECB see going forward beyond the immediate uncertainty scare? Now, it doesn't seem like the ECB is going to be in a position to say or do much for the near term, because, of course, we're back into that situation where the uncertainty with which we now have to operate has kind of hamstrung central banks. This is, again, echoing what Chair Powell said for his part just earlier today. The ECB seems unlikely to be any readier to make a call. But the larger issue is, of course, what ends up happening downwind. Because, again, we have this recession being implied here, but this yield pop was still around the idea of a major fiscal tailwind that's gathering, and indeed next year's expectations are framed in a way where the ECB is going to have to address the inflationary impact from whatever that fiscal impulse is going to look like. And that's going to be something that's really interesting for the ECB to consider, because if the markets are toying with this idea still, then there is perhaps some room for the ECB to talk it down and to say, look, inflation expectations are falling. There's no real scope for us to be raising rates next year in this environment, and essentially name check this. And of course, what that then brings us to is the same conversation that we've had before. First and foremost, is the fiscal hit coming? Are we actually going to get this uplift, or is this, as is often the case with the ECB, or with the Eurozone rather, just talk? We've talked about this framework from optimum currency area theory that measures whether a country will embark on deeper integration, which is really what you would need here to start to have defense integration, where the more integrated the countries in a union, the greater the benefits of that integration. That is to say, the more symmetry there is in the business cycle between countries before they integrate deeper, the more there is a benefit to them integrating further. Because the more symmetry there is, the more the benefits pay and the less the costs hurt. That's the size of the benefit, sort of within this model, where benefits outweigh costs. There is some level of integration that optimizes these things. But of course, we can see that with a increase in benefits to integration that come with military security, a benefit outside the realm of this framework, the upshot is we are going to expect that European Union members would expect a lesser degree of integration as a prerequisite. That is to say, the bar is low to doing this if defense benefits are on the table. And so, on the one hand, the ECB has room to say, well, look, these are all hypothetical things, and right now inflation expectations are cratering because we have a recession scare gathering. There's no room for us to be thinking about rate hikes next year. And that starts to make the euro look a bit softer as you head into this critical resistance going back to the highs in 2023, right around 115.30. Perhaps you start to run aground here a little bit and lose a bit of momentum as the possibility that you get hikes next year falls away. That is to say, the ECB is relatively dovish. However, because this is still likely to occur, it would seem, that inflationary impetus probably is still coming. Just not quite on the same timeline as the market's speculative appetite for it, or at least initially, was presenting itself. So perhaps what we're looking at is an anchoring here, or maybe even a pullback. But as we move forward, the outlook, broadly speaking, still looking very constructive, perhaps with the pullback looking more like an opportunity to buy rather than a reason to be selling, and a bet that still favors dollar weakness as a trend, even if there is perhaps some room for it to recover. And that is Macro Money for today. As ever, we are here right after overtime, show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what it might mean thereafter. On a normal week, we're here Monday through Thursday. That, of course, was a little bit abridged this week, but we're back to live programming as normal next week. And, of course, we'll have Macro Money back with you tomorrow. I'll also be on with Victor Jones for The Price of Truth in just 30 minutes from now. So join us for that. I'm likewise commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Happy trading.
What happens when two titans of trading come together to harness the power of their prowess? Let's watch these two master the art of the noble sport boxing. Wow, look at those geriatric thumbs go. Someone had an extra dose of fibre this morning. Like a flutter of fills, it's definitely fists of plastic fury over here. And I'm spent. Well, lucky for us, Tom and TP are better at writing than they are almost anything else. Subscribe to tastylive Cherry Bomb to get piping hot takes on the market delivered right to your inbox. Sign up at tastylive.com/newsletters.
Trading is hard enough. Here's what liquidity is. You want to be like water. Liquidity is in reference to how easily you can get in and out of a position, from volume to open interest to actual price at which you can buy or sell your position. It's important for all traders, from stock traders to futures traders to options traders or even crypto. Tight bid-ask spreads and high volume are characteristics of good liquidity.
If you missed the live show, here's our cherry on top weekly recap.
You are making it seem I want to go.
I know you do. Listen, there's a lot of things I want to do too.
I'll be the
night last night. I didn't have it in me. But back in the day, I could do it. I'm older now. You know.
Omaha.
Hold on, what did you want to do last night? I missed that.
Don't repeat that. No.
No, what did you want to do?
Do this every time I'm here.
I just want to know what he
every time I'm
what did
here,
he say
we gotta
he
go down
wanted to
this
do?
road.
What did he say he wanted to do?
Do you need me? Do you want me to?
Because usually when he wants to do something, he just said, she says, go in the and do. Here you go. Here's the. Yeah, get in the. See you later.
Nick is gonna be sick.
The last 3 weeks I've been on this show on Wednesdays, it's gone down this rabbit hole.
Nikki's about to throw up.
What do you want me to do? I got 3 old guys talking about. Like, what do you want me to do?
Nikki's about to throw
The
up.
thought of you guys is like sickening. I'm sitting here like this, like, it's hot as hell in here. I'm like sweating, like it smells.
I'm AJ Rudolph. I'm a senior product manager here at Tasty Trade, and I just qualified for the World Poker Tour $5 million free roll in Las Vegas on Friday. So I've been playing poker for about 20 years, actually. I started just with friends. It was like 2005, I think it was, where everybody was like, yes, let's go play poker. There was a huge boom around poker. And I actually feel like that is coming back around again. Right now, there seems to be a lot of interest, and the fields are growing, and everybody wants to get in there, and everybody has a chance to win. That's kind of the cool thing about all of these big events. I feel really privileged that I have the opportunity to go and do this. This particular tournament is only 2,000 people. You cannot buy your way into it. You have to win in order to win your seat, and that's what I did. And so I just buckled in and played my game and really focused and won my seat. I'm a very aggressive player. I do rely very heavily on reading the players at the table. I think that's super important. To be a balanced player, you want to make sure you're doing the math, you're reading the people, and you're doing all of those things in combination with each other, so that way you're using all the tools that are available to you.
You hear it all the time. Spoos up or spoos down. What exactly does that mean? Spoos is a slang term for the S&P 500, specifically the S&P 500 futures contract /ES. It's the world's most liquid asset. In the S&P 500, billions and billions of dollars trade hands each day. The S&P 500 represents the top US stocks, all in one basket, traded through one contract. The S&P 500's movement day to day gives you a good overview of the market as a whole and what it's doing.
All right, we're back. Tasty Crypto Show. I'm Ryan Grace, and with me today, of course, Shelly Van.
Hello.
What's up, Shelly?
Not much. How are you?
I'm good. I feel like we haven't been in here in the studio together in a while. Getting lazy over here. I am personally. Skipped Monday. We did a VOD. When you see that, it's a sign that I've got something else going on, or I'm sick or out or something. But no, we've just been busy in the cave.
Very busy.
So running the video on demand on Monday. But we're back. The chat is back. If you're not in the chat, I don't know what you're doing. Get over to the Tasty Live YouTube channel and pop open the live chat and type something crazy. Type some crazy shit in the chat.
Crazy shit.
You have a question for the chat today?
I want to know everybody's favorite song or favorite band.
Okay.
Who's yours? Or what is
favorite band? I don't know why this just came to mind. It's not my favorite band, but you said favorite band and the Goo Goo Dolls just popped into my mind.
Wow.
Is that weird? That's weird, right?
Okay. All right.
Why?
Do you know a Goo Goo Dolls song, like off the
I know
cuff?
a couple of Goo Goo Dolls songs. Absolutely. The Goo Goo Dolls hail from Buffalo, New York.
Oh, okay.
That's not too far
Flex.
from where I hail from.
Uh-huh.
Maybe that's why they popped into my mind.
Okay.
How about you? Favorite band?
Oh,
Go.
it changes all the time. Right now, I've been listening to a lot of Glass Animals.
Okay. New album came out recently.
Yep.
It's a good one.
And I'm going to see Deep Sea Diver next week. So they're a smaller band, but they're playing at a really tiny venue, which is my favorite. So
awesome.
I'm excited. But shout out to Lone Sophos, Emmett, Messoffs 9. We got some friends in chat.
We got Pink Floyd, Dave Matthews Band. All right. Yeah. A couple favorite bands out there.
Yeah. Can't go wrong with Pink Floyd.
Where do you want to start today? We've got some price action to possibly discuss. I think last time you and I were together on the show, put together a liquidity pool. Presumably, it's not doing very well, given some of what we've seen in ETH. So we did an ETH USDC pool. ETH is down about 50% in the last 3 months. So our pool is probably out of range. We'll check on that. We're going to talk more about Uniswap, decentralized exchange, liquidity pools, favorite topic of the show. We can talk price action. The S&P, I believe, stocks got dumped today, but Bitcoin, 84.5, holding up strong, I might say. What do you make of it?
I mean, I told you so to some people comes to mind.
It is
the doubters.
It's quietly, I think people are sleeping on crypto right here, right? There's a lot of distractions, obviously, at the moment. The 24/7 fire hose of news, announcements, tweets, tariffs, etc., is kind of blasting you in the face each and every day. But in the face of a lot of volatility, we've got the platform up on the screen. So let me just jump to the Tasty Trade watch list here. Take a look at the S&P. Let me get off of a weekly, 1 day. Yeah, you could see fell quite a bit here today. Actually, let me get the S&P price up here so I can get you an actual.
While you're doing that, what up, Jose and Deal Generators, a Metallica fan. I saw Metallica last summer.
Awesome.
That was on my bucket list. So
I hear they're good.
Very good.
Yeah. S&P down 2.2%. Bitcoin up about 1% right now. Yeah, this has been resilient, I guess, to say the least. But I think people are asleep on crypto, given that crypto isn't going to be driven by trade policy. There's correlations at times with equities, and we've seen that when volatility picks up, crypto, Bitcoin, etc., the tokens are not immune. But I think on a forward basis, you've got to look at, okay, what comes next in terms of policy, response, where are we in 6 months? And maybe I'm just talking my book, but if I look at Bitcoin, it seems to be, again, holding up. I'll probably eat my words here, but holding up relatively well, just given how stocks have traded and just about everything else. You can probably throw bonds in there over the last couple of weeks. When I put some slides together, even though we don't have any slides today, we'll run our expected moves on the fly. But putting those together, we're actually higher than where we were last time we put our performance dashboards together. So maybe that's encouraging. That said, ETH still not looking so hot.
No. And yet, I'm buying. Are you buying?
Yeah, I've been adding a little bit, recently. And we can, why don't we jump over to the trading view charts as well, because we have a couple other data points in there that are helpful for what we want to talk about on the show. But recently I've been adding a little bit more to Solana. I have an ETH position that I've held for a very long time. I've added to it here and there. But if I look at some of my trading activity over the last couple of days, I've been buying SWI, I've been buying Solana, a little bit of Bitcoin on the dips. But one thing I want to point out here, and we can throw our indicators up in just a second. I guess actually let me turn those on really quickly so you can see the shift in momentum. So this is what we track on the price and volatility dashboards in the weekly email, which apologies, that one didn't go out this morning. The market update will go out tomorrow, and then we'll have the Saturday on a regularly scheduled basis. But Bitcoin back on a daily in neutral territory, if you just look at this from a kind of price performance or price momentum perspective. Not so much the same when I look at ETH. very bearish here. Solana back into neutral territory. We can flip through a number of others. I know XRP on the Tasty Trade platform still looking kind of bearish here. Here's SWI looking kind of bearish. But when you look at both Bitcoin and Solana, they've moved back into that positive territory, which is step one for that transition from we were bearish to we're back to bullish. I will caution everyone. We saw this at the end of March when we wrote about it. I think the email was titled "Signs of Life," and it didn't last very long. So I'm not getting too excited yet, but something to call out. That said, want to just jump really quickly to the Solana versus ETH chart. So then when you think about, okay, I've got a limited amount of capital, at least I do. Where should I spend it? What should I buy? What should I trade on a relative basis? Well, doesn't mean that it's going to continue, but for a while now, and this is where we can also look at that performance, you got that trigger at the beginning of April, or the signal, and Solana over ETH has been a decent trade, or just, I guess, on a relative basis saying, hey, I'm going to allocate capital to Solana versus ETH. Here's ETH BTC. It doesn't get any worse than that. Here's Solana versus BTC. So I kind of cycle through those three to just see how is ETH trading versus Bitcoin, how is Solana trading versus ETH, and then ultimately how is Solana trading versus Bitcoin, given that Bitcoin market cap dominance is right up there at, well, really multi-year highs. Let's zoom out a little bit here. Yeah, I mean, look at that. Since January 2023, it's been Bitcoin over everything.
Yeah. Never have enough.
What have you been buying?
A lot of the same as you. I have not bought any meme coins lately, except for the funny things we're doing on Zora. So tokenized content. I don't know if we're calling those meme coins.
Yeah, I guess what would you call those? It's tokenized content?
Yeah, like content coins.
Okay. We've got Pump Me Daddy, Fud Daddy. So that's the Tom and Tony. I keep wanting to call them bobbleheads, but
they're stress ball heads.
Stress ball heads. Pictures of them that have been tokenized. I know we're getting deep into the weeds here. And then most recently,
Mr. Wallet.
Mr. Wallet has made an appearance.
Yes.
If
shout out to Lawrence.
If people don't know what we're talking about, which presumably if they're not watching Beans, I don't know what they're doing. But if you're watching Beans, you know what we're talking about. But if you don't, for some reason, where do you find this?
Zora.co.
Okay.
So Zora.co. And then just find us, Tasty Crypto account, and you'll see the ridiculousness that's unfolding. I think Fud Daddy is in the lead for number of holders. But if you attend...
That's the Tom
Yes.
Squishy Head.
Yep.
Okay.
And I haven't looked today, so I could be wrong. Anything can happen in a very short period of time. But we do give away like 100K bags of these tokens on Beans. So
sounds like a lot, but I'm guessing it's not.
Yeah.
Okay.
So but it could be. But it could be.
Maybe. Hopefully for everyone that's a holder.
Mm-hmm.
Mr. Wallet. I do not own Mr. Wallet, and I actually don't own any Fud Daddy. I only have got I've got the Tony head. Yeah, I've got to get in there. And so that's on the Base chain, as I understand it. So you connect your wallet to Base. You've got to have some ETH on Base, and then you can buy
pennies worth,
30 cents worth of this, and you own the content, or you own the token that's associated with the content. It's fun.
It's so much fun.
Yeah, I love it. I love seeing some of the tweets that have gone out, and again, most recently, Mr. Wallet cracks me up.
Next one might be Sleepy Ryan.
Ooh, okay. Yeah, I'm excited to see that one. Going to very quickly here, just punch in a couple of numbers. I know we're doing this on the fly. We don't have our expected moves, but just to update that at a price of 84,500 for Bitcoin and a volatility right now of right around 50%. The expected move over the next week, or on a forward basis here, is just under $6,000, so $5,868. That's not static, as we know. As the price changes, if I just put in the new price and a slightly different volatility, you're going to get a slightly different range. But approximately, you're looking for a move of about $6,000 within one standard deviation, meaning basically 2/3 of the time. So your range there is then about 78.5, 78,631 to be specific, and about 90,000 on the upside. So we're looking at 78.5 to 90,000 as the one standard deviation range, or think about it as a $6,000 expected move.
For the week.
That's right. For the day, if you just look at this in the next 24 hours, what might you expect? Range of 87.1 to 81.8 on the downside. So if you trade those shorter term ranges, and this is not predictive in any way, the implied volatility is a forward-looking indicator. We use implied vol as an input here, but it gives you a sense of realistic expectations. If you look at the price of Bitcoin, you say, well, in the next day, I think it's going to go to 50. Well, maybe, but the relatively efficient option market is pricing in, a one standard deviation or higher probability, a 60% chance or so of 81.8, call it 82, and 87 on the upside.
Sounds good. Can we do ETH and then jump into our liquidity pool?
Yes. Let's do ETH really quickly. So we got an ETH price of 1590. Let's just call it 1600 here. And I've got a vol of 70%. That's a 30-day implied volatility, annualized implied volatility. Expected move 156. Weekly range is 144.4. So let's call it about 1450 on the downside and 1750 on the upside. Daily move $70. 1530 on the downside, 1670 on the upside.
Nice.
Let's talk liquidity pools. Are you ready to take a look? I'm a little afraid because we haven't looked at this since we put it on, and it really quickly went out of range.
Yeah. We knew it was out of range. It's not.
Yeah, we've lost some money, sadly. Started with right around $300. Might have been a little bit less. Generated $589 in fees, but there is risk involved with this. And so as the price has gone lower, it's well below the minimum price of our range, which was $18.50, which you can see at the bottom of the screen, currently at $15.91. We're 100% ETH, and the lower that ETH goes, the more that our liquidity value up here is going to go down. But maybe, Shelly, it could go back up.
I'm thinking
Maybe.
it will.
I hope
Not
so.
financial advice, but hoping so, because I have many pools that are just sitting out of range.
Me too.
Yeah.
Yeah, it's been rough.
Yeah.
If it does go back up, what happens here is that this automatically kicks back on, I guess is the way that you might think about it. And we begin providing liquidity within that range on the Uniswap exchange, specifically on the Base blockchain network. That's an Ethereum L2 from Coinbase, and specifically within the ETH USDC pool on that chain. Right now, not so much.
I want you to walk through how you choose which pool you're going to participate in. Like, first, which pairs are you looking at and why? And then once you've identified your pair, how do you decide which pool to get into?
Absolutely. So the way that I want to think about that is in liquidity terms as well. I personally want to provide liquidity in a pool where there's a lot of activity. There's volume and trading activity, obviously, but there's also a decent amount of TVL, total value locked, right? So that's going to give me a sense of, again, activity, but the fact that there's ample liquidity in the pool, that's where I want to participate. Where other people are providing liquidity, where there's trading volumes that are going through there, and it's going to be in many cases a little bit less volatile. I want to stick to pools that are, at least personally, primarily going to be dollar-based. So ETH versus USDC, wrap Bitcoin versus USDC, versus like ETH and pick your favorite meme coin. I'll pick on DGen for a second. I have provided liquidity in that pool. You have the ETH volatility and you have the DGen volatility. Sometimes the prices are correlated, sometimes they aren't.
Yeah.
And it can get pretty violent pretty quickly as a result.
What's the shortest pool you've ever run in time? Meaning like you were just like in and then out.
Probably ETH, DGen over a weekend. And this is at a point in time where when you're in some of these, it really works a lot better, obviously, when the prices are just ripping higher. Mm-hmm. So you might go out of range on the upside, and maybe you missed out on some gains if you look at it in comparison to just holding one of the tokens. But in a bullish environment where ETH's going up or maybe degen's going up more, you have a higher beta asset in that sense. Those could be pretty profitable pretty quickly.
Yeah.
And I think if I recall, and I maybe had like $5 or $6 grand in the pool and within days made 500 or 600, which you can do that in a lot of different ways in the markets and in trading. It's not a huge number, but just for a liquidity pool and the return, benefiting from the volatility.
It's a good weekend.
Yeah, absolutely. You just get fooled into thinking that that's like the
regular
status quo.
Yeah. You can do this all the time.
And then you lose $1,500 on the next day, you know. But let's get back to the pools. Here's how I would think about it, or maybe what you want to look at. So you're providing liquidity. You have to pick a chain. We're on base. We've primarily been on base because there's a lot of activity there, but also because there's really low fees. Previously, for years, I provided liquidity on Ethereum, layer 1. But it's expensive. And so it can be, you can get into a situation where it's just not really economical. And you have, a finite amount of capital, but you're spending $100 to put on the pool. And maybe that's changed. Gas fees have come down a little bit. But at times where there's a ton of activity, it can be really expensive. Then it's going to take a little bit longer for you to recoup those initial costs or those gas fees. So pick your chain, and you can see TVL, you can see volume across the different chains. But what we want to do to analyze this is go to the Explore page or tab of the Uniswap app. And then we're looking at tokens, so you can see trading activity across those individual tokens on the exchange. We want to look at pools. And then over here, we want to look at one specific chain. So if we're just sticking with Base, we can do that. We can compare similar pools across chains as well. But let's go to Base. And then you can sort by TVL, total value locked. I'd prefer most of the time to be in something that's on a relative basis, is going to have some liquidity in it, some value locked in it, I suppose. You can look at the annual percentage rate based on the one-day activity. So that's going to be variable. It's going to shift dramatically at times. And then you want to look at the one-day volume and then the 30-day volume. And then what I want to see is just a high turnover in the pool. If we make money by collecting fees when people trade,
you want people trading.
Exactly. So you can measure that by looking at, how big is the pool and then what is the notional trading volume. So if I have a pool that is, we'll just say $10 million in TVL and there's $100 million in trading volume, presumably that's a pretty profitable pool. There's other things to consider. There's risks, of course. You're implicitly short volatility. But again, there's a lot of trading activity. There should be subsequently a lot of fees. So that's one way to look at it. I have no idea what this is. AETX. Are you familiar with this?
I'm not.
Okay. Maybe somebody knows. Maybe it might be related to Aerodrome. I'm not sure.
There on my screen.
Yeah, I don't know why that has so much TVL in there. Oh, you're having a hard. You can't see it.
I can't see the screen. Yeah, it's just glared right there. Let me see if I can.
Well, I can read off what we have here. 346 million in TVL here. So I'm not super familiar with what this one is. If anybody knows the AETX token, but going back to where we just were, ETH/USDC and the rest of these pools here, you can see ETH/USDC, as you might assume, is on the base chain the second largest to USDC AETX. But typically has been one of the larger pools. Now, there's not a ton of value that's locked in here in terms of assets that have been deposited into the pool or into the contract. But, we're looking at a pool that has a TVL of 13 million and has a 30-day volume of 1.2 billion. It's pretty good. So we've had a lot of volatility. Likely, you put a pool on, and like we did, you see that, the price was, let's call it 2,000 at that time, 1,850 on the downside. Now all of a sudden the price of ETH is at 1,500. It can move quickly. It could go right back up just as fast. We shall see. But if you're in the pool right now, this is the fee that's charged to the traders that are swapping using that pool or drawing on that liquidity.
I can't see your cursor, so what are you?
5 basis points.
Okay.
And then you look at the APR currently, it's almost 67% annualized. Pretty good, right? I mean, you're going to make almost $7,000 on a $10,000 pool. That's not going to be a fixed rate, but that's a pretty insane return. And people believe that it's not possible to do these sorts of returns. Well, it still is in liquidity pools. People call these things Ponzi schemes. No, this is a real thing. There might be many other kind of enticing yields and things that like, okay, where does the yield come from? It's not real or it isn't true. That does exist in not just crypto, but in many things. But here, this is simply just derived from trading activity. And we're showing you that it's a pool that's got, called $13 million in it, and it's got over $1 billion in volume. In the last day, it did almost $50 million in volume. So if you're in that and you are providing liquidity within that defined price range, you're receiving a good chunk of those fees because this pool is getting hit and liquidity is being drawn on it quite frequently, given what we're seeing. So that's how I start to think about, is there an opportunity in one of these or the other? If I have a small amount of capital, I might want to participate in a smaller pool because I'm going to be a larger portion of the overall aggregate liquidity. And as a result, I'm going to receive more fees. But there's other variables to consider as well. It's not just like, oh, let's pick the smallest pool. Well, the smallest pool in terms of TVL might also be the most volatile.
Right.
Maybe that's a good thing, maybe it isn't, but something to consider.
Since we're running out of time, Jose has a question for you. Have you done any LP on Solana? And if you have, what DeFi have you used?
I haven't done anything recently, but a long time ago, I provided liquidity to Jupiter Exchange. I think, some of these use much different models or kind of have a different way to interact with them versus the approach that we've described on Uniswap. So go and check those out. But yes, you can provide liquidity to Radium. You can provide liquidity to Jupiter. There's other exchanges that you can provide liquidity to. You'll see that this is a mechanism that exists in perpetual futures and some decentralized exchanges there. Trying to think what else comes to mind. I mean, even on Base, Aerodrome, it's going to be a little bit different experience than the interactions and the way that we've talked about providing liquidity on Uniswap through the automated market maker there. But if there's trading activity on a decentralized exchange, there's likely there is a way to, as the user, provide liquidity to that exchange and participate in the fees, the rewards, to benefit from that.
And then Michael, so the liquid goes in the pool? Yes.
Yes.
You put your coins in there, people use them, you earn a fee.
I love it. Just jumping back to this one more time, we are out of range. So anybody that might be new to this, if you want to learn more about liquidity pools, we have a decent amount of content on this on the Tasty Crypto YouTube channel. So get over there, subscribe to the channel, and check it out. We'll talk about this in more detail going forward. But you're basically providing liquidity for trading purposes on the exchange, and you define how you concentrate that liquidity within a range. Similar risk profile for options traders that are out there as a strangle. But basically, you want the price to stay within the range. If it goes above, you have sold out of all of your ETH in this case, so it's like a covered call. Now I just have dollars. The price of ETH keeps going up. Let's say it goes to 3,000. I don't benefit from that in the same way that I would if I held ETH. Very similar to a covered call. Then on the downside, it's like a short put. So you are going to be buying ETH as it moves lower and lower within this range until you've used all the dollars or USDC that you started with, and you've bought all the ETH that you can with those dollars at those current prices. Below 1850, you're just long ETH. You can see that at the top here, 100% ETH in terms of the makeup of our pool. Current market price, if this keeps going lower, we have that exposure to ETH. So it's no different than you take assignment of 100 shares of stock, sold the put at X strike, it keeps going lower from there where you were signed, you're going to lose money, at least on paper, unless it goes back up. We're hoping that this goes back up. We get back within that 1850 to 2244 range. We're providing liquidity again to anybody that's swapping on the exchange, and we are going to start to generate more fees versus the $5.90 in fees that we did generate while this was in range.
And for any normies in the house, when we're saying ETH, here you're seeing WETH, which is just wrapped ETH.
Yes.
And we don't say it like Ryan, because he says weth.
Weth. You can say it however you want.
No, you cannot. Don't do that. Don't be like Ryan.
That's funny. Yeah, I'll never forget the day I learned that I've been, I say a lot of things incorrectly.
It's okay. We all do. But that one I will make fun of you forever.
You can hold it against me.
Yes.
Yeah. Well, Shelly, thanks for coming on the show and hanging out with me here in the studio. And thanks to Lone Sophos for the nice comment. Thank you for another great show. Thank you all for showing up and hanging out with us here on the Tasty Crypto Show. Beans is off on Friday. We're off on Friday. It's Good Friday. So if you're off on Good Friday as well, hope you enjoy the long weekend. We'll be back on Monday with Beans on the Tasty Crypto, what I call Tasty Crypto Network, on the Tasty Crypto YouTube channel. And again, in the afternoon, 4:30 Central Time, on the Tasty Live Network with the Tasty Crypto Show. Yeah. We got to work on that.
You got all that?
I think so. But that's going to do it for our show. Until then, I'm Ryan.
I'm Shelly.
Peace.
I distinctly remember getting an email from Tasty that Lookback had just been released, and I was doing the most laborious back test on the face of the earth before that. And I did 2 or 3, and I saw how quick it was, and I saw how quick the data was. And basically, instantaneously, I was hooked. I'd always seen all the stuff on Tasty Live with all the data and all the value I thought that bring. And then it was all of a sudden I could control that and basically make my own segment for myself of what fit. And that democratization technology, I think, drastically changed not only the landscape of what's out there, but drastically changed my ability to learn at such an insane rate. And that's kind of when I developed a little bit more of my own path. I was like, this is the type of trade I exactly want to see, or I'd get some type of inspiration from Tasty Live to look at that. And that's when my consistency went from 1 to 30, and I haven't had an unprofitable quarter since.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and Tasty Live web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
If you missed the live show, here's our cherry on top weekly recap.
I had the, what do you call the hot girls dinner?
Oh, you had girl dinner.
Cheese plate?
There. It was so gross. It's like that old monster from Tales from the Crypt.
Get the full scoop by checking out the archives at tastylive.com.
Oh, yeah, it's Wednesday, April 16th, a little bit after 5 p.m. Central Time, the best time. You know what that means. It's time for Tasty Live's evening show, a little podcast called The Price of Truth, a show where we like to explore the incentives that govern our world. And good God, are they giving us incentives to chew on each and every single day. Shout out to everybody watching on tastylive.com, Tasty Trade desktop and mobile applications. But if you want to be part of Bing, did I get it? Bing. This little chat box in the middle of your screen. There's only one place you can do it, and that's on Tasty Live's YouTube channel. So head on over there, subscribe to the channel, which will get you access to type, whatever appropriate or inappropriate characters you'd like to throw into the middle of the screen there. Shout out to all of you already participating in the chat. You know what to do. Spoof the Google algorithm. Without further ado, our special guest this Wednesday, and I'm so glad, perfectly timed, quite frankly, after that Powell speech and the market reaction, is our good friend, head of global macro here at Tasty Live, talking, of course, to Ilya Spivak. Ilya, how are you, my friend?
Took a little vacation at the start of this week for a quick 2-day trip up to northern bits of California, and while the weather was nice and everything seemed beautiful. It looks like the markets have not unclenched in my absence. And the folks I was talking to up there, wineries and olive oil makers and producers of every stripe, non-white collar America, you might say. The word on the front of their lips is tariffs, and they're worried.
You don't say. you don't say. I could see that happening. You went on a vacation, bro?
Yeah, my parents took the kids to Disneyland, so we had a little pocket of time, and so my wife and I got in the car and drove up north.
Oh man!
Up the north coast there to Mendocino County.
Treating yourself right, as you should. My wife and I, good God, I don't know when's the last time we were on a trip without the kids. I don't know. I couldn't tell you. It's been at least 6 years since they were all born. So never. All right, man, let's jump right into it. There's so many angles that we could take here. Let's just start with what happened. I'm sure most of you know this by now, but the S&P 500 closed down 2.25%. The Nasdaq down 3%. The Dow Jones down 1.75%. The Russell was the outperformer, if you want to call it that, only down 1%. What gives, man? The catalyst was what today?
It's an interesting thing to say that we're searching for catalysts, because if you look at, let's call it a daily chart of, let's say, the S&P, just for sake of argument, it hasn't really gone very far in the past several sessions. And when you look at these big swings, 2% swing here, 1.5% swing there, they look big because we're used to swings that are much smaller. This is obviously not a normal level of volatility. But if you consider kind of where we are price-wise, we're essentially back to the bottom of the range that we started to carve out last week, when we got that big pause, I guess, kind of, in the tariffs. It's interesting to call it a pause because tariffs still went up from an average of about 2% to an average of about 10%. We just didn't get the extra tariffs beyond the 10%. Those got put on a 90-day hold. But the markets clearly liked that there seemed to be a kind of responsiveness to at least bond market chaos last week, where the administration came back and kind of softened its stance and sort of reduced the gradient of its tariff on-ramp. And essentially we said, okay, we're going to take this slower. We're going to negotiate. We're going to give this a 90-day pause before this really bites. The market has a huge rally and then sells off the following day amid this kind of digestive thing, because, of course, none of the uncertainty has been unwound. And since we had those two moves, we're kind of in a range. It's a very choppy range, but not much has changed. I think the tone of negativity today within that range probably comes down to comments from our favorite central banker, one Jerome Powell, of the great and powerful Federal Reserve, that didn't say anything differently from what we might have heard from him after the last FOMC meeting, or since he's spoken at other venues since then. But the markets clearly are wanting for him to say something different, and they clearly are wanting for the Fed to come and give them some sort of a relief.
Yeah, they want
the money. They want to pad themselves in cheap money so they can ride this out in a more confident state, and they're not getting it. And the Fed is telling him, look, maybe we'll see you next year, which was, I thought, a very interesting comment.
Yeah, or the markets are functioning. I thought that was like the perfect summary of what his comments were. You know, the markets are functioning. It's kind of like coming out and saying, yeah, hey, sometimes markets go down, bruh.
It's like, listen, you play stupid games, you win stupid prizes. Here we go.
There's this line in a movie that I love. And Cameron, he has this line. He goes, "Hey, people get shot every day, B." And I feel like, in a way, Jerome Powell just came out to Mark. He goes, "Hey, people get shot every day, B."
Hey.
So a couple things stood out. I don't know if you got a chance to watch the whole speech at the Economic Club in Chicago. Shout out to Chicago, Austin Goolsby, and the whole Chi-Town crowd. I don't know if you got a chance to watch both the speech and a little bit of the Q&A, but were there some things that stood out to you? Obviously, the broader theme is I see what's happening. I see what's happening. Still two-sided risks. He even mentioned that both sides of the mandate may come in conflict. There was a few lines that stood out to me. What stood out to you in that discussion today, Ben?
I think for me, like the biggest sort of piece was, of course, and this is shouldn't be shocking to anyone, the part where he says that tension between the goals for the Fed puts it in a difficult position, because on the one hand, it's looking at these tariffs as likely to be a one-off price increase at best, but it's turned out to be a larger tariff effort than even their upside case expected. And so they see their job as making sure that it's a one-time price increase, and they see that as a exercise in managing inflation expectations. But at the same time, they see that the tariffs are a hit to growth, and that pulls them into divergent directions on policy. And they don't know yet how to calibrate the middle path.
Here's what I heard in that, and maybe I'm reading too much into it.
I think you're not. I think you and I probably came to the same conclusions, judging from the SEP that you've just pulled up.
So when I hear
but by all means, sir, go ahead.
When I hear him say, remember, this is in March that they put this SEP out, right? And this is before you know what the tariffs are going to be, but everybody knows that they're coming. So at some level, they're putting out this projection, trying to project some
and Powell said
future.
This directly.
Right.
In the press conference
future.
after, he described it exactly as you've just described it.
So what I heard in that statement was that the tariffs were bigger and more impactful than what they had projected. I hear that perhaps this is optimistic, and perhaps this is not high enough.
Right.
That's kind of what that's what I heard.
Exactly. I think that's exactly right. I think he basically came out and said, look, we're no closer to seeing what the tariffs actually do, because we're still in the kind of, we're delaying this, we're delaying that. We've just established a 10% tariff basically across the board, whereas the average before was about 2 across the board, if you sort of averaged them all out. So, okay, tariffs have gone up on net, again, averaged out, right? You can go country by country and things get different. But averaged out, you have about a 5-fold increase in tariffs. But it's just occurred. It's going to take months to really see it work its way through the economy and really give you kind of real substantive impacts in things like GDP. I mean, we just today saw retail sales numbers that were surging. They were surging for all the wrong reasons. They were surging because of tariffs on autos and auto parts and people front-running those tariffs. If you took kind of the obvious tariff front-running out of the retail sales numbers, the rise wasn't 1.4%, it was 0.4%. So you take a whole percentage point of a monthly increase out of it, but nevertheless, you still haven't seen kind of the bite to growth. In fact, if anything, the tariffs have been a magnet to boost activity as people kind of rush to squeeze it in before the costs go up.
Same thing with Chinese GDP, don't you think? Don't you think their number was...
Absolutely.
I think that was all just front running. Mm-hmm.
Absolutely. And the thing is, you saw it in Chinese PMI numbers already going back to late last year. Mm-hmm. And you've already also seen that it's faded in the PMIs. So you look at this GDP and you go, well, that's cute and all, but the PMIs told you that this was coming, and now they're telling you it's already gone.
But I actually think we're going to see that in a lot of. That's why. Yeah, I think about the earnings season, and I think we're going to see the exact same thing. I think people are going to see a bunch of numbers that blow away the estimates, but then they give either no guidance or lowered guidance, because why would you try to be the hero into an uncertain future? So in the same way, you just got a better than expected GDP, you got better than expected retail sales. I think all that's telling you the same picture. You're going to get pretty good earnings numbers, but that's not what matters. If the market believes we're at this tipping point or this inflection point of the economic cycle, what we did 3 months ago is not going to matter, and that's going to make it really, really difficult. I know you're not like a binary bet guy, but I think that's going to make it really tough for binary bets this earnings season.
Absolutely,
because it's not going to matter what they did.
No,
not at all.
And the thing is too, the markets already know that it doesn't matter, because if you look at the break-even rates, and this I thought was the most interesting part of Powell's speech, as relative to how the markets present themselves. Powell says, listen, we have to make sure that whatever price increase there is from the tariffs, that it's a one-off. That there isn't a push into inflation expectations from this. And the way that we're going to manage that is with rates. And since we don't know what that means yet, because the tariffs haven't hit and we haven't seen them really show themselves yet, since we don't know that, we're kind of hamstrung, but we can't be cutting rates in this environment because we don't know what's going to happen to inflation expectations. We can't have them get unhinged. But if you look at what inflation expectations are actually doing, they're falling. And they're not just falling in the US. They're, for example, also falling in the euro area. They're falling elsewhere as well. As if to tell you, the markets have already looked through the cost upside from the tariffs and are now looking at the cost downside, which is to say, markets as ever are forward-looking, and when they see a hit to inflation that's going to hurt growth and hit demand and create economic weakness, they've already moved on to that part of the story and said, yeah, okay, maybe it'll be a cost uplift, but on net, inflation is going down. And the reason it's going down is because whatever this does to dissuade consumption and investment is going to so thoroughly hit economic activity that the demand pull on inflation will be so anemic that inflation will actually be net lower, not net higher. For all the wrong reasons, of course, but net lower. So higher unemployment, weaker spending, weaker investment, negative growth, perhaps.
So what's
and
the
you're
bad
seeing
news?
it, and you're seeing it everywhere. Well, the
this
really
good news
interesting
from you, Ilya.
that the Fed already, it's saying, oh, we don't want inflation expectations to get unhinged. They're already not unhinged. They're heading the other way. And so what the Fed needs here is something to sell. It needs a piece of hard data. Retail sales didn't help them. NFP didn't help them. They need hard data that tells them the scales aren't in balance. They've gone to the growth side of your focus. Go. Because if you look at what's actually being priced in for this year, it's still rate cuts. About 80 basis points of them.
They already got a cool CPI, but obviously one is not a trend. Do you think to your point, we could be, basically the way this is going to set up, the market is expecting the first cut to come in June.
Yeah.
And it seems like that's probably enough time if the last CPI, some of that inflation data, if that becomes a trend, it seems like that's basically going to open us up and cement that June 18th meeting to start that, to undo the pause of the cutting cycle or start a new cutting cycle. I don't know what you want to call this, but it does seem like we're opened up for another.
We're looking at about a 68% chance, to your point. You're absolutely right. 68% chance of a cut in June. By July, you're starting to get into maybe already a 35% chance of another cut by then. Then of course, it opens up. If you look at what's on the menu for the year, this year, you're looking at this point at 87 basis points and then a further 25 basis points next year. So the market is feeling a sense of urgency. It wants 4 cuts now. I mean, 84 basis points is closer to 4 cuts than it is to 3. Narrowly so, but nevertheless. And so you're starting to get to a place here where markets go, okay, la-di-da, you're saying all these things, but we think the growth side of the equation is already overwhelming whatever inflation expectations thing you're concerned about, because they're obviously already going the other way. You just need license now. Let's give you some really weak economic data. But if this front running continues, to your point, and if we continue to push things out, 90 days here, 90 days there, and it seems like the president might want to do that because he now has a point of leverage on these tariffs. Is he going to press the button to end the delay, or is he going to delay it again? This is now a negotiating vector for him. And that makes sense. He has a tool now where he didn't have one before. And so we have a deepening uncertainty that then is what you're looking to see in growth. Not so much that the tariffs are hurting growth per se, but that, as we've been seeing in the PMIs since the beginning of the year, people just don't want to spend money because they have no idea what's going on. And so they've just retrenched from doing anything that they don't have to until there's more clarity.
Can I ask you, somebody's mentioned it in the comments, and I think Tom and Tony brought this up, I want to say a week ago, that they think that the Federal Reserve is going to be put in a position to raise rates. And I just do not see that. I mean, it's there as a possibility. I don't even see that in the ballpark of probable at this point. And I wonder, Ilya, what would you say to the people who think that Jerome Powell is going to raise rates? Whether he needs to raise rates, that's a whole different conversation. Whether he's going to raise rates anytime soon.
I don't think that we are doing ourselves any kind of a service by going into an environment as uncertain as this and painting hypotheticals that are directly contradicted by the collective wisdom of the market.
Yeah.
Look at the price action. Okay, maybe let's give the devil his due. Let's take for a second and hold the idea that we think the Fed is going to be put in a position to raise rates. If you went to go and trade that idea now, what would you do? What would you buy? What would you sell? I don't think anybody has an answer to that question. And whatever you did on that assumption, could you reasonably expect to make money on that bet? No, because the market is very clearly taking you in the opposite direction. It's pricing in more easing in Fed funds futures, and inflation expectations in the bond market are cratering. And by the way, not just in the US. And so you look at all of this and you go, okay, well, so if I think that the Fed is going to have to hike rates, in order for me to make that into an actionable thesis here and now, I have to fight the entirety of the global financial system because I'm right and they're all wrong. Well, okay, maybe you're right. Good for you. Eventually. But to trade that here would be a recipe for disaster because the market clearly doesn't think the same way. It's one of those great Ira Harris moments where you go, if you're right at the wrong time, you're wrong.
The nuance that I would add is I tend to think that consensus is the least profitable opinion. So in a way, I sort of I like the idea of trying to find where the market maybe has put all their eggs in a consensus basket and looking for, high payout ratio outcomes. The problem here is, in this case, I would rather bet the under than the complete opposite of the market.
Right.
You're going to be raising rates versus the market is priced for and a possible next year, and maybe I want to take the under. I think that's probably a more reasonable bet, because we have seen the market prices what it wants when it comes to easing. So to say that like the market's been over aggressive here in the amount of cuts it's priced in, that's possible. But I think to go a direction where we're talking raising rates, I don't think it's highly probable at this point. I think it's like a less than a 5 delta. And furthermore, I think people have gotten used to this idea that the Fed somehow magically controls the entirety of the curve, and they don't. It is very possible if the market even partly agrees with you, lowering the short end of rates is actually going to end up raising long end rates. And you're going to get a weird steepening, which in a way loosens part of monetary policy and it tightens other parts of monetary policy. If 10, 15, 30-year rates go higher, what is that going to mean for trying to get a mortgage on a new home? So I just think it's easy to think the Fed controls the whole part of the curve, but the reality is their monetary policy really controls the short end, and the less QE, the less stuff that they're doing, the more the market is going to control the long end of the curve, and the growth in inflation expectations are going to control the long end of the curve. So that's the way I would think about it and frame it.
Well, and also, it's one thing to be a contrarian on price. I get that. Absolutely. I mean, clearly, last year is a case in point. I was contemplating the short side for stocks all year last year and kind of trying to take shots at it, saying this thing looks weird here. So I'm very open to the idea that the not consensus bet is the bet to make more often than not. But that's different than betting against growth expectations. If you're betting against assets, that's one thing. If you're betting against what the market is telling you the growth dynamics are, you're not betting against an asset. So taking the market's view of the evolution of the economy 1 to 2 years forward, that's probably a given. That's not something to bet against, because that's not an asset. It's a lens on how you view assets. And then getting the not consensus bet there dialed in right to say, okay, well, I think the Fed isn't going to do 5 cuts, let's say. I think they're going to do 4, or I think they're going to do 3, or maybe they'll get back to doing 2, which is what they intended at the beginning of the year. Well, let's say that. What do I trade on that basis? Well, it's unclear what that is, per se, because a lot of the market relationships that we've seen have broken down. For example, the bonds have been selling last week, and a little bit less so into this week, but obviously sustained massive damage last week. Why? Was it because the Fed got more hawkish, or was expected to become more hawkish? No. Not even remotely that. So,
what do you think?
Why? Well, I think it's very clear. I think the term. I
don't think it is.
I think it's incredibly clear.
I know you do. Why do you think it is?
Term premium in bonds has absolutely surged. Break-even rates are down. It's not inflation expectations. But term premium in 10 years, in 5 years, has surged. In the 10-year, it's at the highest since January. If you looked at then something like a measure of credit market volatility, the Office of Financial Research within the Treasury Department puts together an indicator. It's called the OFR, Financial Stress Index. You can confirm what you're seeing in the term premium there. It shows you the structure of the indicator and gives you a number of sort of categories, and one of the categories is volatility, which is just a measure of implied and historical vol across asset classes, and that measure off the charts, telling you that what people want is compensation for duration because they have a perception of the forward-looking environment that's less certain, and they want to be paid for risk because, like all of us, they're looking at a clouded landscape and go, well, we don't know what kind of thing might happen with duration, so if we're going to lend over a longer time frame, we want more money. I think it's pretty straightforward, actually.
Yeah, I agree with that. I thought you were going to say something else. I agree with everything you just said. I also think we're just in the part of the business cycle where if
you thought I was going to say that money is leaving the U.S. because
I thought you were going to say a very top line.
I hate that argument.
Narrative, and when it comes to the bond market, that's always,
I hate the argument. Absolutely hate the argument that people make in this scenario and in others, saying, "Oh my God, the U.S. is going to lose its status as the global currency of commerce, or as the preeminent risk-off debt instrument." Stop it. That's ridiculous. There is no alternative. That doesn't mean that there's not gradients between everything is all peachy and the U.S. empire has irrevocably collapsed already. There is an increase in the level of risk to holding U.S. denominated assets, as you can see with the rise in uncertainty in the term premium in the bond market. And so there is a level exit of capital to some extent from USD denominated assets, be it the dollar or bonds or stocks. And that does not say anything about the long-term prospects of the dollar or of the treasury market or of the credibility of both. There's no other place. Full stop.
I agree with this. I agree with the sentiment. I think that right now you can find a lot of hyperbolic statements on Twitter or just in people's general commentary. I think that level of I think that the level of statements that we're hearing about, this is the end of the dollar as a world reserve currency. I think people are probably over-rotated. Do I think we are raising more and more questions to global liquidity and what is the right store of value given the amount of risk on the table? Yes.
Absolutely.
Do I think we've crossed some point of no return? No. I do
or some point of structural change where the whole architecture changes. Because again, there can be gradient changes within.
Yes. However, there's a part of me that also goes, I don't know how you think about 1971, or I don't know how you think about the Plaza Accord, or within the system. If you call leaving the gold standard, if you call Plaza Accord, or sort of these debt restructurings that we've had throughout the years, if you call that a structural change, or if it's just a sort of a pivot within the same structure, it does seem like every once in a while,
one of those things I can
completely unmanageable, and we have to sort of do a global restructure of debt.
I don't think it's a debt issue. I think a lot of people get that wrong. I think it's kind of ludicrous to say, and the example I've been using to sort of illustrate it is this. Let's say that I'm a billionaire, but I haven't worked in 3 years because I've been on a spiritual quest in South America somewhere doing pounds of ayahuasca, and I have returned now, and I haven't made new money in 3 years. but I'm a billionaire. And I walk into a car dealership and I say, I have not a dime on me right now, but I can show you my assets. I want a car.
Yeah.
Am I going to get the car? Yes. Are they going to penalize me terribly on the interest rate? No. Why? Because they know I'm good for it. Why? Not because they're assessing my income this year, because they're assessing my asset base.
I think this
the U.S. sits on the largest, richest asset base in known.
I think that's why we got ourselves in this situation. People that think that debt doesn't matter it seems like they have not studied history, and they keep convincing everybody else that that's true. And we're going to find ourselves. We're going to find ourselves with more and more good money going out the door and squeezing out more productive uses of the money. Instead, it's paying interest. And the more we get people like you who are on these big platforms telling people that debt does not matter, the absolute level may not, but like we're at 120% of debt to GDP. And the more smart people that get on here and tell people debt does not matter, it's crazy, bro. It's insane.
I don't think it's crazy at all.
I think you have to be able to. It always matters. If you play it out long enough, it always matters, bro.
Well, so you've said the thing to history. You've said the key thing. You've said the key thing, which I agree with. If you play it out long enough.
Yeah, so if that same dumbass billionaire keeps going into enough car shops and you figure out, like, wait a minute, how many of these loans do you have? How many do you have? At some point, yes, it does impact whether or not that guy gives you a goddamn new car.
At some point is the key. My point is that the notion that we are in anywhere near anything like.
But that doesn't mean you just be irresponsible until you get to that point.
Of course it doesn't mean that.
So then it does matter. Debt does matter.
Again, the question is when and which debt. The idea that the annual deficit matters is ridiculous.
No, it isn't. What do you say?
It doesn't matter. No, it's not.
Jesus.
The cumulative government debt.
Dude, this is brutal.
The cumulative government debt eventually matters if, to your point, it is left unchecked and you get to a place where interest payments start to crowd out the productive economy.
You're already there, bro.
Which is a disaster.
If we were in a mall and we were looking at a map, you know how it says you are here?
Yes.
What you just said is when we get to a place where our interest payments crowd out, we pay $1 trillion on interest, bro. If we spend $800 billion on defense, it's already crowding us out.
Those numbers don't matter. They only matter as a function of their share in the total, and the total has grown leaps and bounds more than those outlays. Again, for now. This is a long-term issue. Everybody has very correctly pointed out that the trajectory is unsustainable, that it needs to be addressed. But the idea that we need to worry about the current today standing of U.S. debt for any reason other than the creation of completely self-inflicted uncertainty.
I'm just going to buy Bitcoin. It's so brutal. It's like if everyone thinks this way, it's like I'm just going to buy Bitcoin and watch you guys
nobody thinks that the longer-term issue is not an issue. Nobody thinks that the long-term issue is not an issue.
I'm just going to watch the Fed monetize the debt once we get there and just inflate everybody into poverty. And I'm just going to go, F it. I'm just buying Bitcoin. And I'm just going to sit there
and hasn't rallied.
Hope for the best.
Funny enough.
Hasn't rallied. Bro, it was up 2% today while the NASDAQ was down 2%. The most interesting part of today's price action, in my personal opinion, is not the 3% dent in the NASDAQ. It was that at one point, Ilya,
compared
the NASDAQ was down 2%. Yes, but this is actually where I wanted to go with most of the discussion today. Is this, to your point, I don't want to go hyperbolic about people ditching the dollar. However, I want to acknowledge that price is king. And today,
of course,
Price was telling you gold is the preferred store of value. And even Bitcoin performed incredibly well in a day. Everyone's telling me that Bitcoin is a high beta NASDAQ. So explain, and I get it, one day it's not a trend.
I don't think that's true anymore. And I think the reason it's not true is very much what you're talking about.
Mm-hmm.
If Bitcoin were still a high beta NASDAQ, it would be tanking as stocks are. And it isn't.
Of course.
And it isn't.
Agree.
It isn't. Like anything else, it is a commodity, essentially. A digital commodity, but a commodity. That's priced in dollars, and the dollar has been sinking. Gold has been soaring. Other currencies against the dollar have been soaring. Yen is soaring. Euro is soaring. It's not about gold. This is about not dollar.
Mm-hmm.
And not dollar is about term premium and uncertainty, which is why bonds are selling off. And stocks are selling off. And anything dollar denominated is selling off at the same time. The issue with the longer term situation about the trajectory overall of the U.S. fiscal situation is well understood and completely agreed on by pretty much everybody, most importantly, the Fed. Powell absolutely wastes no opportunity to get out there and go, the fiscal trajectory is unsustainable. He's right. There's no question. I mean, anybody who sees sort of the 20-year arc here, if things are left unchecked, if things were to have been left unchecked.
5 years. 5 years, we drive off a cliff on Social Security.
We can quibble about that. But the idea that today,
that was such a gangster way to swim past that. We can.
I think 5 years.
Point.
I don't think anything's happening in 5 years. But
okay.
Here's how I would. Here's the caveat I would put on that.
Okay.
Any kind of trajectory that you might have extrapolated as of December 2024 and January 2025 before the 20th, you can't really extrapolate it anymore. Because you had growth at a particular level, and now growth expectations are falling apart. So debt to GDP ratio math is changing very quickly. And indeed, if you follow through with the trajectory we're currently on, which is tax cuts, probably a lot more fiscal outlay to fight a recession, unemployment benefits, blah, blah, blah. Probably less of a tax take because economic hit, right? How big then the deficit balloons if at the same time you also drive up the refi cost on it because of an inflationary spook, such as there might be, right? The Fed is sort of trying to figure out if it's there. The market thinks it's not. The Fed is still worried. Nobody actually knows. If you get an inflation spook on top of it and rates go up, well, yeah, you're going to get to a fiscal crisis much faster. There's no question. I just don't think anybody knows that here or can extrapolate today at all like they could extrapolate knowing the growth trajectory, the trading norms, the economic dynamics, let's say as of December. Because clearly the markets were not afraid of tariffs in December. They became afraid of tariffs later, in February, when the uncertainty started to hit business confidence and consumer confidence. Before then, nobody was concerned. I think that the key that people need to hold here is the idea that the markets are now, today, viewing the U.S. as not a good borrower. And that there are more appealing, more safe sovereign borrowers out there, and that's what this is. I think that's just very obviously wrong.
No, it's people are worried about their purchasing power, man. It's
That's
not
right.
It's not the strength of the borrower that people are worried about. It's the funny money they're going to get paid back by lending the United States over a 10-year term or a 30-year term. And if you're nervous about that, then you take some of the money that you'd be allocating on treasuries, and you stick some of that stuff in gold. And you and I talked about that like
and
months
other
ago.
currencies, and
This
there's
was
gradients.
likely that the situation in Russia set us on this path. I think that was a big, the actions that we took against Russia, or economic sanctions, were a big part of getting the world to go, hold on, wait a second, and starting to rethink how you hold dollars, and then seeing our fiscal situation and going, okay, wait a second, what's the likelihood that I get paid back with anything other than monopoly money over the next 10 years, given all the problems that these guys have? And I think you start asking those questions, and you go, you know what, maybe 3.6%, maybe that's not an appropriate yield given the risks that you're facing. Yeah, you're a billionaire, but you know what, I don't, 3.6 doesn't make a lot of sense to me. And maybe 4 or 5 doesn't make a lot of sense either. Maybe we need to be somewhere in the 5% range or higher, as some really smart people are calling for. And I wonder if people understand, if we get to that level, just how much our economy, how much pain the economy is going to take in trying to digest those yields that we haven't seen in a really long time. Do you agree with that?
I think the connection to what we've done with Russia and the weaponizing of the dollar is not a connection that I make, because there's not credible evidence for it. When the war broke out in Russia, the dollar strengthened, and it strengthened all year long. Now, of course, the Fed was also hiking that year, which helped to obfuscate, perhaps, to some extent. But also, if you look at the latest numbers that we have from the Bank of International Settlements that tracks these things, and fortunately they haven't published their 2025 update yet. It's coming later this year. The latest update was back in 2022. The share of the dollar in global payments actually increased. So I don't buy this whole idea that the weaponizing of the dollar that we've done already has moved anyone other than the target countries. There is no question that China has been thinking about building a rival payment system in yuan. They were thinking about it before the war, and when Russia became a desperate buyer of non-USD financing and monetizing of trade, obviously China was able to significantly ramp up their counter system. Russia has been advocating, for obvious reasons, they need an outlet for an out. I think that's clear. What I don't see is anything that's structural. Gold reserves have clearly increased in China at a blistering speed.
Right, and that's what I'm talking about.
Sure, they're trying to build. We've talked about this before.
No, I know, but you're saying two things at one time. You're saying both on one end.
I am saying
that the economic sanctions didn't change the way people thought about the dollar.
Not people.
And then you're also saying that China significantly increased their gold reserves in 2022, following Q3 of 2022 and after.
Yes.
And I'm saying those two things are opposing thoughts. I
don't think they're opposing thoughts at all.
And after, it encouraged China.
I don't think they're opposing thoughts at all. I think when the targets of the policy chafe under the policy, that's a very different thing to say than the world has lost confidence in the dollar because the U.S. has weaponized it.
I think that's fair.
That's all I'm saying.
I think that's fair. I should have been more specific.
Yeah, that's all I'm saying. The targets of the policy, Russia and of course China as Russia's kind of other game in town as their outlet, of course they're chafing. Of course. There's no question. I mean, we've talked about this where gold seemed to decouple for a while from yields and the dollar on the upside. And this idea that this is just Chinese buying, because while they may not be able to credibly have a yuan system, if they say, because the yuan is not easily convertible, they may be able to say all the trade flows on our rival to SWIFT, they're all backed in gold. So you can transact on this thing and know that there is something liquid you can exit out into. And for that, you need to buy a lot of gold. To basically say the trade settlement on our internal system, CITIC I think it's called, is gold backed. So you can know that there is liquidity and convertibility there. And that makes sense. But sure, of course, China and Russia want a rival system. But nobody else is along for the ride.
What do you do with gold here? 33.65, hit another high today, 33.71. And this was like the little engine that could. We were moving just a little bit in the day, but the distribution was always sort of right distributed. Mm-hmm. And now, they took out 100 points, over 100 points for 3 days in a row, and the speed with which this thing recoils up and makes up that ground is absolutely incredible, bro. And now at 33 and change with 100-point move, over 100-point move, what do you do with it here?
I'm not a buyer because I think this is getting a little crazy, and I think it's getting a little crazy in particular if you look at the bond market. Over the past 2-3 days, bond market has unclenched a little. Mm-hmm. If you believe, as I do, that what's happening in the bond market is not about the Fed for the past week and a half, it's about this term premium idea and increased uncertainty and just an exodus from USD denominated assets of every stripe. Gold is obviously reveling in that. Mm-hmm. So is the euro, so is the yen. Pick a currency. They're reveling in it to different degrees. I think so is Bitcoin, which is why it's not getting shellacked along with other forms of high risk. However, if the bond market is unclenching, that means that the level of uncertainty is maybe unclenching also. Like maybe the market is ready to have arrived at the place where it's run out of fresh fodder to price in more. And if that's the case, well then some of the gold rally looks overdone now. And some of the dollar selling looks overdone. Mind you, I'm still very short dollars and have been, as we've talked about, for weeks now. So I'm looking at this and going, man, where do I exit this thing? Because it's starting to get a little long in the tooth. But you get a day like today in the euro and you go, well, this is not today. This is not the day I stop being long euro. You look at the Aussie, this is not the day I stop being long Aussie. You look at the Canadian dollar, you say the same thing. You look at the yen, you say the same thing. I'm long all of them. Have been since February or earlier. So for me, I look at the bond market, which I'm also long, and saying, okay, if this is starting to unclench a little, then maybe the dollar is going to find a little room to rebound, gold pulls back some, and then everything becomes a buying opportunity again because the trend is toward weaker dollars because ultimately, to the point I think you were making before, the way this resolves is the Fed gives people cheap money. Mm-hmm. Because the way this resolves is a growth scare. And the market is already telling you that's the way it resolves.
What can you expand? Can you define what you mean by growth scare? Do you mean that we won't actually get into a recession? People are just scared about growth, or do you actually mean
No.
it's all? You mean all encompassing, regardless of the deceleration in growth? What this is the pre-pricing of what that ultimately becomes.
I think if you take what Powell told you today and in March and in between as your framework, right, and you say the Fed doesn't know if it needs to prioritize inflation or growth, and the reason it doesn't know is because nobody is quite sure what these tariffs are going to do. Now extrapolate that as a microcosm to everyone involved. Consumers, business leaders, everybody. The markets, they're all looking at this and going, we don't know. And all we know is that we don't know. And so there's this uncertainty. But I think what increasingly you're starting to see, especially in the bond market, especially in the makeup of yields, if you start to break down yields and you go, okay, here's the break-even rate, here's the TIPS yield, that is real yields net of inflation, here's term premium. You add together term premium, break-even rate, TIPS yield, you end up with the nominal bond yield as it stands. Okay? And increasingly, the things going in there are less break-evens, which are falling, and more term premium, which is rising. And what that is telling you is the market has already told you which side of the ledger the Fed needs to worry about. It's not inflation, it's growth. Maybe we're going to get to call it a recession. Maybe we're not going to get to call it a recession. I find it very hard to imagine a way that we're going to get away from a formal NBER called recession if this continues, but we'll see. I don't think anybody knows that answer, but clearly the markets are telling you this is going to get resolved the growth route, where growth is going to weaken. The Fed is going to have its sort of catalyst to act because it will resolve which side of the coin it needs to be on, and it's going to cut. And it's going to cut a lot. Maybe not as much as the markets are hoping, but it's going to cut maybe more than twice. More than they originally thought. Let's say 3 times, going on 4. Maybe, depending on how bad it is. And that ultimately that means higher bonds. But it also means a weaker dollar. But that eventually what this will mean is a kind of shift back to more sort of normal dynamics, where sort of what happened before last week, where you go, okay, this is a growth scare. Bonds go up, yields go down, dollar is sold. We're aiming for the Fed to come and firefight some sort of a recessionary adjacent something. But then you get the Fed saying, we don't know what we're doing because we don't know which way to jump. You get an NFP report that doesn't help them. And now a retail sales report that doesn't help them. And now Powell has said twice between a week back from this past Friday and today, hey, our scales are in balance in the worst possible way. We don't know where to go because we don't know which risk is greater until the data tells us. And what we want is for the hard data to tell us. Bond market is already telling them, though. So I think if you get a dollar rebound here, because the uncertainty unclenches, and you get a gold pullback because the uncertainty unclenches, if the bond market is telling you things are starting to resolve toward the direction of just growth is going to be bad, the Fed's going to cut, rates will come down, that's the way that policy goes now. If that's what the bond market is already saying, then any dollar rebound is a sell and any gold pullback is a buy. But you wait for those things as opposed to acting now.
Let me go a specific stock direction. We don't do this very often, but I don't really want to talk about the price of NVIDIA so much as the story that surrounds it.
Yes.
And the sort of the tit for tat with China, the sort of the limiting of supply for rare earth, and the licensing that the U.S. government has slapped on NVIDIA, the write down that they've taken, the $5.5 billion, something like this. I wonder if you could just opine on the tit for tat that you see sort of developing between China and the U.S. as it relates to semiconductors on a broader level.
Well, I think this sort of speaks to the larger environment and the idea that this is going to be a growth scare. I think a lot of people are walking away from COVID, especially, and saying, well, you know who doesn't care about a growth scare? Tech doesn't care about a growth scare, because look at what happened to tech stocks during COVID. They absolutely soared because they're not selling anything that you have to go into a store to buy. And I think that's sort of a narrative. But I think what this NVIDIA news today and sort of the supply chains story more generally, I think what it's telling you is that nobody is going to prosper if there is a growth scare, not one that's elective, because we go and turn off the global economy and send everybody home, then give them all a bunch of government money to not starve, and thereby keep demand robust. Just shift that demand from services to goods and to whatever tech can sell you while you're still sitting at your desk, be it whatever it is, video embedding into apps and AI and all of that. That actually what's happening here isn't going to be that. Everybody's going to suffer. And there is no kind of hideout in tech during the recession playbook that people might have carried over from COVID. That's not what this is going to be. It's maybe going to be one of the great funny developments in this entire thing. If you sort of think about what we're doing here. I heard a lot of people smugly running around and saying in their critique of the president's policies, what in the world does the trade deficit have to do with the fiscal deficit? These are completely different things. We're totally shooting at the wrong target, blah, 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 blah. Well, that's not really true, and that's not really right. But the problem is that nobody from either side seems to be talking about what the actual issue is and what the vulnerability is, because there doesn't seem to be a whole lot of understanding of the architecture here. And I'll try to summarize it quickly. When we have a trade deficit with other countries, right, we still buy stuff in dollars. They sell stuff to our consumers here, hence imports. So they end up with a giant pile of dollars because they just sold us a bunch of stuff. We paid for it in dollars. Now they have all these dollars. But if they then convert those dollars even back into their own currency to reinvest the proceeds of their trade with us back into their own economy, what happens is they're selling massive amounts of dollars. And if they do that, the dollar collapses. And we no longer are able to buy their imports. It eviscerates their entire business model because it kills our purchasing power of their stuff. So nobody is actually interested. So they recycle the dollars back into our economy, primarily financial markets. And what that has done over 40 years until recently, obviously, is it's enabled us to have low borrowing costs, not just for the government, but for everyone involved, ample liquidity, And that has been a tremendous boon to U.S. growth. The U.S. has outperformed the rest of the comparable universe on growth by leaps and bounds. And of course, those low interest rates and that high growth help us to manage our debt. And first of all, keep debt to GDP ratios in check, and also keep us looking like an asset-rich borrower that does not face a serious constraint on repayment. That's not a big repayment risk. But in undermining the trading system, we break that cycle. Not fully, because again, I don't think that we're going to some sort of catastrophic unwinding of the dollar as the preeminent currency of global commerce, because again, there is no alternative. But again, in gradient terms, we kill a significant share of global trade with us with these tariffs. That's fewer dollars that get reinvested. That's structurally higher rates. That makes all of our debts more difficult to manage. These things are, and then to your point, you get to a credit crisis much sooner. So all of this stuff affects everybody. Nobody escapes that. Not NVIDIA, not anyone. And then you get into a much more troubling situation. So I think when people are going to look at this, they're not going to ultimately find, and I think we're already there. I mean, the NASDAQ is obviously getting shellacked here along with everything else. I think as you get past the kind of sentiment spook and into the growth implications, maybe there was the sort of idea that tech, like during COVID, would survive, but this is a different environment. The problem here is different and much more structural.
Yep.
It's going to hurt everyone involved. There is no safe harbor within equities for what this could become.
Yeah, I agree. I think I posted something, an interview that Besant had, I think it was yesterday on Yahoo Finance, I want to say. And in it, he sort of outlined what we all know, but he said it in really simple, straightforward terms. I think he was asked by Brian, what's your best case scenario in a deal with China? What's it look like? And he gave a big setup to his premise, but it ultimately landed in they boost demand, they stop or they limit their state subsidies to manufacturing, and then the U.S. increases its manufacturing base and then decreases its consumption a bit, is what he said. And I was like, bro, if all you did was listen to that, if all you did was listen to that little piece, it's like that's enough for you to understand just how not good this is for stocks.
Just how much this is not going to work. Yeah,
we have a consumption-based economy, and the Secretary of the U.S. Treasury says the whole goal here is to lower our consumption a bit, and I mean that's so huge. And I remember this the New York Times article they ran back in November. I want to say it was. It was like the guy who broke the Bank of England might be the U.S. Treasury Secretary, and I remember how much irony is packed into that. This guy broke an entire Bank of England, and now he's running the U.S. Treasury. How wild!
Yeah. I mean, Besant, I believe, was there with Stan under Soros when they did that.
Yeah, he was there.
I mean, it was a Druckenmiller idea, but obviously they were all there.
Yeah.
So interesting, of course, but the more I listened,
but to your point, to simplify, to getting down to just the simple strokes, the simple stroke of what this, from the administration's point, is to limit China's ability, or to ask them to decrease their state subsidy in manufacturing, which would then make
and by the way, that's
our
a
manufacturing
fair
more competitive. It would make our manufacturing more competitive, and they increase their consumption, and I'm assuming what comes along with that is market access to that consumption, and us limiting our consumption a little bit. And,
I think
that seems to be the goal.
I mean, you can sort of follow, because again, the assessment of the problem oftentimes in this administration is spot on.
Mm-hmm.
Of course, China has gamed the system with tremendous state subsidies, which should be incompatible with its membership in the World Trade Organization and the norms of conduct that membership demands. This is not a controversial position. It's a bipartisan position pretty much anywhere in the developed world. Whether you go to Europe or Australia or Canada or Japan or Korea or the US, nobody doesn't think this in the sort of lever pulling wing of the policy spectrum around the world. Everybody in the control room of any major economy understands what this is. Obama was trying to deal with it through treaty back when he was president. Never mind what then happened with the first Trump administration and Biden, which was just progressively tighter screws on China. The entire TPP idea that the Obama administration was trying to put together was to say, we are going to write the rules of trade in the Pacific. We are going to get absolutely everybody to sign on to what these rules are, and we're going to exclude China, so they have to live by these rules if they want to trade with anyone. Which would have been an elegant solution, maybe. We'll never know, because obviously that's nowhere on the menu, and we abandoned it. Maybe that would have been an elegant way to address this. But if the goal is to say we are going to rebalance the U.S. closer to a growth model similar to China's and rebalance China to a growth model more similar to the U.S., that is to say, get China to consume more and get the U.S. to manufacture more, I mean, besides the fact that that's very unrealistic because of the vast differences in levels of economic development from one country to the next. But besides that, let's say it is realistic. Let's pretend that unicorns are real and pigs can fly and the plan is realistic. It's a multi-year idea. And where you're definitely not going to get is anywhere near that if you tell if you tell factories in the U.S. this tariff might go away in 90 days.
Yeah.
Okay, go spend 5 years building a factory. No.
I think when I've said this online, I've said that I think with you in a conversation, it's total conjecture. Yeah. But I think any way I play this out, it ends with programmable currency. It ends with programmable government-issued currency. Any way
I've argued this. I've argued for a long time that the future, and I agree with you, that the future of crypto isn't in the tokens, sort of specific tokens like Bitcoin or Ether or this or that. That the truly disruptive power of crypto as a technology is to the banks and the credit cards. And because they are currently the piping for the system, and the future of crypto is a digital dollar, a digital euro, a digital this, a digital that. That is to say, sovereign fiat that is cleared and where the ledger is managed by the central bank, where then you don't really have to have your money at a bank in a checking account in order to make payments. You don't have to pay them fees. You don't have to do any of that because the central bank will do it for you, because they are able to do it with the benefit of crypto technology. They're able to do these massive ledger management experiments at scale where they couldn't before, and they needed a banking infrastructure and a payments ecosystem to manage it for them. And that what this is actually a threat to is the banks and the payment companies, who are going to have to do the investment company thing and go deep discount and offer everybody the services they now reserve for high net worth clients, like wealth management and investing and everything like that, because they need people to have their money in the bank account. They're going to have to give them a lot more services and cut fees a bunch.
Lucid in the chat says, I agree with that, by the way. Lucid says, it's insane that the ask or ideal situation is so contrary to both sides' culture and ideology. Consumerism is our religion. Boosting consumption is a no-no for China, LOL. And I think some part of that is sort of the base of my thesis for the programmable currency. If you really need China to become a consumer, and they, no matter how much money you give them, they just won't spend. They put it in the bank account. They put it in savings. They put it in, and you need to get around that. The programmable currency is a solution for that. You give somebody some stimulus check that expires unless used by, and in the same way, limiting on the U.S. side, you want to change behaviors. Programmable currency has the ability to do that here. I'm scared to death, and I'm not saying that that's on the horizon in any way, shape, or form. I just see it theoretically as a solution to many of the different problems facing governments and facing centralized planning. So
it's certainly the issue in China, because they've just lost everybody's confidence. It's not like China had a loss of. It's not like China stopped consuming because they stopped consuming, because they were never consuming. China was a huge consumer market pre-COVID, and a whole big thing for Xi was to rebalance the economy away from exports toward more consumption-led growth that was more sustainable, much as we did. I mean, it's so silly. The arc of the U.S. becoming wealthy. Why did we construct this free trade system after World War II? Because number one, we bought ourselves a giant economic boom because we spent a ton on fighting back the Depression and then a ton and a half on the war. And of course, that gave us an economic boom, but it also gave us tremendous inflation over time, which we then had to deal with. That was the 70s and already, by the way, into the 60s. But we bought ourselves a government-financed economic boom. It worked like a charm to level us up. But, and of course, we had all the factories that were untouched by the war while Europe was in shambles. Obviously, we wanted free commerce because we said, hey, we're going to go rebuild Europe. We're about to get rich. And boy, did we. It worked. Just not without costs. So we built this architecture. We're going to build the next architecture. This will resolve itself. But China was very much in the same lane before COVID, saying, look, we've spent all this money, we've borrowed all this money, we've created this giant thing, but now it's created distortions. And if we don't switch it to a consumption-led model, this thing will cave in on itself. Well, then you had COVID. They scared everybody half to death. Nobody has any confidence in Beijing doing the right thing. And they won't spend their own money on stimulus. All the attempts at stimulus they've made so far has all been, well, if we just give you lower mortgage rates, then you'll have more money left over. Then you'll go spend. Or if we pump a bunch of money into the stock market, you'll feel better then, right? And then you'll spend. Or we'll lower bank reserve requirements. Then you'll have more money left over. Then you'll spend, right? And the people keep saying, no, because you won't put your money where your mouth is. We are going to save the money. We don't have confidence in your ability to steer this ship and to bring growth back. We don't believe you. And China, to their point, Chinese consumers are not dumb. That economy has been in a deflationary spiral for the better part of 2 years. It's not working. All of their stimulus, all of their incentives, all of their inducements, they're not working. What they need, ostensibly, and we'll see if it works or not at this point, is for the government itself, not for regional governments, for Beijing itself to go, you know what? Here's a Western-style stimulus effort. Here's a bunch of money, go buy stuff. And you know what? We're going to buy stuff and create a level of economic activity and kickstart this thing in size, like what the US did with COVID, like what Europe did with COVID, to get people to actually believe that they're serious. Nobody believes. It's not that Chinese consumers are averse to consumption. It's that they're looking at their own government and going, well, if you won't do it, why should we?
Let's do this. We got 5 minutes left. Let's use this last 5 minutes to be highly actionable on market opinion.
Okay.
So I think you are still structurally bearish on the major equities. I wonder, though, if you could speak to the fact that we're at 5,300 in the S&P after what looked like a nice little, I'm guessing what you would say, what you would call a dead cat bounce or a bear market rally. How are you thinking about risk now up here at these at the 5,300 level?
So when a week ago from this Monday, last Monday, the market stopped selling off, but the news didn't get any better. And we talked about this on the show last week. I got out of my shorts and actually went long and bought some essentially sold put verticals in SPY and in the Qs, so S&P and NASDAQ. Basically saying if the market won't keep selling, but the news isn't any better, then it's probably done. Something has changed. The news flow has to catch up. Then we got that big rally when we got the pause, partially, on the reciprocal tariffs. I got out by the end of that day. I caught maybe like 7% of that 9% rally and just got out saying, look, the news isn't any better, and what this does is introduce more uncertainty, not less. So I get why sentiment has unclenched, but this ultimately doesn't solve anything. This is not going to be a rally that lasts. So I got out. Since then, the only one I've put back on is Russell. And the reason why I've put the Russell back on and not the S&P.
Meaning short Russell now.
Short. I bought puts. I bought a put vertical in Russell. And the reason why I did it in Russell and not in the rest is because although the Russell was a little bit better today, it has started to break back down. Whereas if you look at the S&P or the NASDAQ, they're still holding at the bottom of that range that we were talking about at the open of the show. If you look at, let's say, ES or NQ on like a 4-hour chart, let's say, you can very clearly see where there is a line through the current range. On NASDAQ, it's about 1,800, where you get the sell-off, a bounce, a pullback, then the big rip with the delay. Then we pull back to retest that internal range axis, and we're sitting right there. I don't think there is the actionable signal here yet to say we're not just digesting that big rally, we're back to actively selling. The S&P looks exactly the same way. Russell, on the other hand, has actually broken down into the lower sort of quadrant of the range and is having a hard time looking as constructive as the others. And if this is a recession scare, that makes sense. The weak names, the sort of smaller cap names in in Russell, they're going to get punched in the teeth first. They're just not as cash rich. A growth scare is going to hurt them faster and harder. So I've gotten into there. I haven't re-entered short elsewhere. I'm looking, obviously. If we get an actionable signal, I'm right back in there. But I'm not doing anything with the S&P and NASDAQ for now.
And then bonds, I think you're long and staying long. Is that fair?
Yeah.
And I don't think
I'm
you're
long.
in ZB. I think you're in TLT. Is that right?
I'm in TLT. Last week, I actually added a little bit to the position, but whereas the
Is it
initial
just long stock? Are you just long the ETF, or you have like an option?
No. I have verticals. So I started off buying call verticals while vol was low, because I was expecting, look, we have a recession scare. This is going to be lower rates. And until Monday of last week, when we sort of got this more generalized exodus from USD assets, it was working. The bonds were at the highest since November. Obviously, they've since sold off. I'm not a big believer in this sell-off, because I still think that ultimately lower rates, Fed stimulus, and all of that is the path of least resistance. We just need to get past this uncertainty spook. And so actually last week, when it seemed like we have kind of a Trump put, just not in the stock market, but in the bond market, that maybe there's a tradable low there now. And so I started to sell some puts, verticals, in TLT. And so actually I have exposure both ways now. I'm long a call vertical from a couple weeks back. I'm short a put vertical from last week. And that's helped me to kind of bring down the cost of the position and to get more long even as volatility has gone up. And basically look for the bond market to unclench and to resolve toward this is just a dovish Fed thing.
To not leave you out there alone, giving your own opinion, I'll put mine out there as well. I'm net long portfolio delta, but as we got to the 5,500 level, right around 5,400, I started to put on portfolio drag. So I'm short like NASDAQ futures over the top of a long portfolio. So and I was short a little bit of NASDAQ, long a little bit of Bitcoin, long a little bit of silver. And so like today, the portfolio was basically flat. Maybe it's down a couple $100 or something, nothing at all.
Yeah.
And I'm long bonds as well, but my preferred instrument of choice is ZB. And I did something similar. So when bonds were getting just straight punched in the face, I think around 112, I took some long upside bets, and my exit range is 115 to 117. I think we'll get back to 117, but at 115, I thought I'd start to scale out. We just hit that number here today. I don't have the same level of conviction I think that you and Chris have in the long end. I think it's very possible, best case scenario, in my personal opinion, you get a small rally to long end yields kind of stick around where they are right now. I think that's probably best case scenario. Worst case scenarios, we start cutting and long end rates lift again like they did last September. It's a very different situation than last September though. So I could totally see what's that, the bear steep. I could totally see yields falling and steepening at the 210s, steepening at the same time. I'm guessing that's what you think is going to happen.
Yeah.
So I could see that. I have less confidence in it, which is why I just want to pick my spots in bonds. I don't necessarily just want to go all in for the recession trade.
I mean, I agree.
So then the last one here.
I'm relatively small in it, and basically the idea is the Fed hasn't blinked yet, which means more rate cuts need to go down along the curve. Soon as the Fed blinks, the trade's over.
Right. I have nothing explicitly on in the dollar. Obviously, everything is sort of in a one way or another, an implicit dollar trade, but I have some gold plays on, some silver plays on, nothing in the dollar. It seems like you're short dollars here, but you think we might be getting to a point where you could see a counter trend move. But you're not going to try to pick where that spot is. You're going to stay in there.
For now. I am getting a little antsy here because easily the best way that I have played what's happened basically since the beginning of the year was to really lean short dollars. And I mean against everything. Pound, euro, Aussie, CAD, yen. I have bought everything that's not nailed down in the FX space against dollars because to me that was the all-weather bet. Like either the Fed is cutting or we have a loss of confidence. You pick. It's dollar negative. So that's easily the trade that's worked the best for me. Having said that, it's already had a pullback once along the way from the lows. You can see it in the euro here. I can see another one. I can see a more sizable one. I think we can get back to 111 without too much of an effort. 112, 111 on euro, easy. And all that would be is the market unclenches, bonds go up because the term premium comes in, uncertainty eases, and the market goes, oh, okay, Fed's going to cut. They've seen what they have to see. So I think actually when you get the next piece of U.S. data that's really bad, that actually scares folks with recession, I think you might actually get a stronger dollar. Because that brings the Fed closer to conviction. Bonds go up, yields come in, dollar actually strengthens because all of these extremes start to look extreme. But there's no price action validation of it, and until there is, okay, I'll sit.
I really like that. Ilya Spivak, we're 5 minutes over. I want to thank the production team for being patient with us, but we are going to get them out of here. We want to thank the audience for hanging around with us. And Ilya, you as always for sharing your abundance of knowledge with us and not calling time, giving us the extra 5 minutes we could work through those sort of last the last more actionable pieces on how you're thinking about these instruments. My friend, if the people want you on their side as they're navigating markets, tell them where they can get more of your content.
As ever, I'm all over the network, especially in the afternoons. Macro Money and Overtime are after the close every day, Monday through Thursday. Obviously, it doesn't make much sense on Friday when the markets are already closed for the week. You and I are here once a week for all manner of deeper discussions on this show. You and I are also on with Tom on Sundays for the Futures Market Open, the APAC Market Open on First Call. I'm writing for the News and Insights area of tastylive.com, and I am opining sporadically, let's say, on both the platform formerly known as Twitter and on Blue Sky at Ilya Spivak.
You can find me on Twitter at Victor Jones. The Owen Jones is 0 because I like to be difficult. If you would like an audience, a more personal one, you can send me an email to victor.jones@tastylive.com. My sincere gratitude and appreciation for your time, Ilya. I look forward to our next conversation on Sunday. For all of you, thanks for hanging around. Hit the like button on your way out. Subscribe to the channel if you have not already. I'll see you back here tomorrow, same time, same place, same great network, only on Tasty Live. Peace.
Peace.